of the Round Rock, Texas-based company. In New York, Charlie Pellet, Bloomberg Radio.
Earnings continue today from one of the nation's biggest semiconductor firms. Those details now from Bloomberg's Tom Busby.
Broadcom's latest earnings expected to show a sharp boost from unprecedented demand for next-generation artificial intelligence chips, with Citi saying the company is likely on track to raise its full-year AI revenue target from $8 billion just one quarter ago to at least $11 billion. But overall revenue may be offset by some weakness in its legacy chip offerings. Bloomberg consensus calls for adjusted earnings per share of $10.80, revenue just topping $12 billion. Tom Busby, Bloomberg Radio.
Shares of Broadcom now 1.3% higher. Vera Bradley reported net revenue for the first quarter missed estimates. Vera Bradley makes those quilted bags and accessories. It lost more than $8 million. CEO Jackie Ardrey says visits and spending are down across all of its platforms. Shares of Vera Bradley now down 16%. And trading volume has surged. And Apple shares rose to a record after it revealed new artificial intelligence features, betting that a personalized approach to the technology will win over customers. Shares of Apple more than 4% higher. And that's your company news at this hour. I'm Amy Morris.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. Happy post-CPI day. Happy Fed Day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We keep you updated on all the top news in business and economics through our lens of our Bloomberg Intelligence analysts who cover 2,000 companies in 130 industries worldwide. We also keep you up to date on world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, Amy. Secretary of State Antony Blinken says that mediators will keep trying to close a ceasefire deal after Hamas proposed numerous changes to a U.S.-backed proposal. He said today that some of the changes were workable and some were not. Blinken in Qatar said Hamas recently offered a ceasefire proposal that is nearly identical to the current one on the table.
A deal that the entire world is behind, a deal Israel's accepted, and Hamas could have answered with a single word: yes.
Secretary Blinken says we are going to continue to push with our partners, Qatar and Egypt, to try to close the deal. A new poll done by the Pew Research Center says people around the world are more confident in Joe Biden than Donald Trump. Bloomberg's Ed Baxter has the story.
Pew says this is a poll done in 34 countries. It found a median of 43% saying they trust Biden to do the right thing in world affairs, compared to 28% from Trump. People had more positive assessment of Biden than Trump in 24 countries, while Trump led in Hungary and Tunisia, and the two were effectively tied in 8 others. But this comes as well at a time when global faith in U.S. democracy is waning. A median 4 in 10 told pollsters that democracy used to be a good example for other countries to follow, but that it no longer is. Ed Baxter, Bloomberg Radio.
North Korean leader Kim Jong-un hailed the country's expanding relationship with Russia, as reports suggest that Russian President Vladimir Putin will soon visit the country for his 3rd meeting with Kim. North Korea state media reported today that Kim sent Putin a congratulatory message marking Russia's National Day. Jerry West, who was selected to the Basketball Hall of Fame 3 times in a storied career as a player and executive, and whose silhouette is considered to be the basis of the NBA logo, died this morning. Jerry West was 86. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex.
All right, thank you so much, Michael Barr. So here's just a fun story. The headline: Congress seeks raise after 15 years. They haven't had a raise in 15 years. And representatives across the aisle, from Republican firebrand Marjorie Taylor Greene to progressive Democrat AOC, they want to do something about it, saying that it hurts economically diverse candidates and that they really need a salary bump after years of inflation to retain them. Rank and file House lawmakers make $174,000 a year. Okay. I got feelings about this.
Go.
So you don't have a raise in 15 years. That stinks.
Right.
So, you definitely want a raise, for sure. I get that. But that implies that you're in the seat for 15 years, and still, that salary, $174,000, is nearly triple the $65,000 average pay for U.S. workers, and they get pensions, right? Don't they get a lifetime health insurance even after they leave. Okay. And I mean, they have a bazillion breaks. I don't know.
Here's what they're saying. We have lost some really great members over this. That's a quote from House Appropriations Chair Tom Cole. To me, we ought to do what we did with the courts and others and hold the talent that we have. So I guess they're trying to frame it into a situation. We haven't raised our salaries for our members for 15 years, so we're slipping below elite professions like lawyers and corporate CEOs and less than half an average Wall Street salary. So if you want to get high quality talent to Congress, you're going to have to pay more competitively, is the argument. But it just seems odd not to have a raise in 15 years.
For sure.
Like, there hasn't been a raise in New Jersey Transit fares in like 5 or 6 years, and now they're going to bump them up like 15%. So I don't know why everybody just doesn't raise
everything with inflation.
Yeah.
And then we're all kind of like on the same page. All right. More thoughts on that. Coming up, we'll have the CEO of Next Era Energy.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Anne-Marie Hordern. She's the chief political correspondent and anchor of Bloomberg Surveillance. She's in Puglia, Italy, where the G7 summit is going to take place. So we'll get a preview from Anne-Marie from the ground there. John Ketchum, president and CEO of Next Era Energy, publicly traded companies, to discuss how electricity demand is dramatically increasing. And then David Kudla, founder, CEO, and chief investment strategist at Mainstay Capitals, going to call to give us his market call on the back of this inflation print and right before we hear from the Federal Reserve. But right now, let's kick everything off with Mr. Charlie Pellet.
Thank you very much, Paul Sweeney. Lots going on. Right to the numbers here. Fast-moving markets to the upside on this Fed Wednesday. CPI Wednesday as well. S&P now with a 54 handle. 54.37. Yes, a record up 61. Right now, that is a gain of 1.1%. In the year-to-date column, S&P 500 index will round it up to 14%. We've got the Dow up 164, up 3 points, up just about 0.4%. The NASDAQ Composite Index up 310, a gain of 1.8% right now. 10-year, 4.26%. The 2-year, 4.68%. Spot gold up $9 the ounce to $23.27, a gain of 0.4%. West Texas Intermediate Crude, 78.04 a barrel, up 0.2%. We are brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Consumer Price Index this morning, which excludes food and energy, up 3.4%, cooling to the slowest pace in more than 3 years. Reaction to the CPI print from Francis Darnold, global chief economist at Manulife Asset Management.
As exciting as this is this morning for a few hours, I'm more interested on the CPI print that comes out September 11th, just 1 week before the Fed's September cut. That number may end up being much more important than this one. So we'll take it as a win. It's good news for consumers, for markets, for all, but it's one print.
FedEx cutting as many as 2,000 jobs in Europe. FedEx down 0.1%. Rival UPS up 0.2%. Again, recapping, we've got records for the U.S. stock market. S&P right now up 1.1%. 54.37 on the S&P 500 index. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. I'm Alex Steele alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio, our second hour right here in the Interactive Broker Studio in Midtown Manhattan. So we're here, and, that's cool. But Anne-Marie Hordern, well, she is somewhere very fancy. She's the chief political correspondent and anchor of Bloomberg Surveillance, and she joins us now live from Italy. Anne-Marie, I got to say I'm a little jealous of this assignment. But what's on the docket for you?
I definitely think everyone's a bit jealous of this assignment, given that it is in Puglia. That's where G7 leaders are going to be meeting, Alex. And just as the president recently left Washington to head to the southern boot of Italy, we heard from the State Department and the Treasury Department expanding the scope of sanctions, really going after third parties, whether it's third-party banks that allow Russian banks to use, and they use their Russia version of SWIFT, the financial messaging system, or it's going after third parties, most notably a lot of companies in China that still sell either U.S. branded or that uses U.S. technology when it comes to chips, and that Russia is using in everything that they're trying to use in their war machine, like missiles. So we just saw the expansion of some of these sanctions. On the margins, we see the U.S. are trying to close some of the loopholes that Russia has been using. But overall, the big deliverable and what the Biden administration would like to see get over the finish line is, of course, the ability to tap into the mobilized Russian assets. It's $300 billion worth, basically. It's sitting in Europe. Now, the Europeans has taken a step forward that it's willing to tap the interest on those assets, but that's only about maybe $3 to $6 billion a year. What the United States would like to do is have a long line of liquidity about the future interest payments of these assets, and that is really where the discussions are right now. We've seen a draft communique, and notably missing was the language on how the plan on how they would be able to do this.
Anne-Marie, what's the policy outlook for the G7 as it relates to China these days? What would they like to get a message out regarding China?
Well, we've already heard that they want to send a signal to China, and I think these sanctions that we have from the Treasury Department and the State Department really relay that message, is that they want to make sure, and they said in the communique, that they want to call out China, which they believe and is enabling Putin and in his ability to fund this war and get the supplies he needs to fund this war. So that's the message to China. What's so interesting as well, of course, is that as the leaders start to descend upon Puglia, we already had the European Union in a separate probe that they had with China regarding electric vehicles actually increase the tariffs on some of these Chinese manufacturers. So it does feel like those trade tensions are really starting to ratchet up as we head into this G7 meeting.
All right, Anne-Marie, thank you so much for your reporting. Anne-Marie Horton, Chief Political Correspondent and anchor of Bloomberg Surveillance, joining us live from Puglia, Italy, for the G7 summit, which will take place this weekend. Markets on the move here. The S&P 500 up 1%, the NASDAQ up 1.8%. Let's see where the action is under the hood. We check in with Nora Melinda. She is equities reporter for Bloomberg News. Nora, what are you looking at?
Well, I mean, of course, we can't stop looking at tech stocks this morning. It seems as though the market has a mixture of a risk-on appetite, but as well as flocking to the safe haven sector, interest rate-sensitive sector, real estate. But as we look at tech stocks, there's a lot moving here. But I mean, I really do want to point out Apple. As we mentioned, it is seeing some extensive gains, of course, coming off of that Worldwide Developers Conference earlier this week. But actually, Apple did overtake Microsoft in market cap on an intraday basis today. And this, of course, has it regaining its title as the world's largest stock. Now, it still has not closed above Microsoft since January, so we're going to have to see where this shakes out as we head into the close and, of course, going through this Fed meeting. But definitely something interesting to point out here as we look at the tech space.
And speaking of the tech space, let's go to U.S.-listed China EV makers. I made the leap there, tech to EVs. So there's like something.
I followed.
Thank you. So what's up there?
Well, I'm watching these U.S.-listed Chinese EV makers because the EU said that it will impose additional tariffs on EV cars shipped from China starting next month. This should go into effect around July 4th, if I'm not mistaken, but this will take levies to as much as 48%.
This is huge. I mean,
massive.
Yeah.
I mean, this is definitely going to escalate the trade tensions and, of course, the cost to buy an EV. So we're watching a lot of names like BYD. Apparently, Tesla is also a bit in the mix as we think about just these car shipments and everything that's going on here, but definitely a sector to watch.
All right, what else we need to keep our eyes on here?
I mean, I, of course, am always watching real estate. We already knew where I was going with this one, didn't we?
We did.
But
that's all right. We like you.
Looking at some of the most beaten down names, actually, we've got office REITs, so those landlords of office properties. they are gaining. They're seeing their best day of the year. Of course, all in the mix of this interest rate question. I saw earlier we were expecting the first rate cut to be November. Now it seems as though traders are pricing this in as early as September. I mean, the market's antsy and they're ready for some cuts. So let's hear what Jerome has to say later this afternoon.
All right. Thank you so much. We really appreciate Norma Linda joining us from Bloomberg News. Thank you so very much. So one thing in the market is if you look at, say, the top sectors in the S&P so far this year, you get tech, you get information, get consumer communications, thank you very much, but you also get utilities. And a big part of that utility story is, sure, you get some nice yield, and it's that safety defensive play, okay, but I'm starting to wonder how much of a growth sector it is also, as you see massive power demand built from data centers and AI, in addition to the energy transition. Utilities kind of sit in the middle of all of that. And one company is NextEra Energy. It's ticker NEE. The stock has had a nice run up this year. It's not done so well in the last couple days, and we'll get to that after an investor presentation. We'll get to that with the CEO and President, John Ketchum. Hey, John, it's so good to see you again. Thanks for coming in.
Alex, great to see you. Good to be here.
So tell our viewers first, what does NextEra Energy actually do?
Well, we're made up of two businesses. One, we own the nation's largest rate-regulated utility, Florida Power and Light. And two, we are the world's leader in renewables, wind, solar, battery storage, a unique combination bringing those two companies together.
But you still have like nuclear and gas too, right? Like
we do.
For the utility side.
We do. So we cover it all. We're in every part of the energy value chain, not only renewables. We have 6 gigawatts of nuclear, and we're one of the best operators in the country on the nuclear side. And we also own gas-fired generation. 72% of our generation fleet in Florida is actually natural gas-fired. So we view ourselves really as a very credible source in being able to advise our customers on what the lowest cost option is for generation.
Owning a utility, electric utility in Florida would seem to be a tough business with all the weather down there. What happens when these storms come through? How do you guys, you have to almost be in a constant state of emergency almost to be able to react.
We are battle tested. That's one of the great things about our company is that nothing catches us up by surprise. And it comes from a culture of continuous improvement and innovation. And we practice and we drill. And we've had, 49 hurricanes in the last 20 or 30 years. We're never caught by surprise. We're a company that is used to managing through diversity, and that's one of the strengths.
So you mentioned catch by surprise, and I mentioned the stock price in the last couple of days. So there was an investor presentation that you made, and where you outlined your forecast this year through 2026. You're also 2027 midpoint profit forecast. That's the one that analysts said that falls short of our estimates.
Yeah.
And I guess the question is, if data demand and data power is going to drive so much demand for your stuff, why isn't that midpoint higher?
Well, here's what we see, and we talked a lot about this at the Analyst Day yesterday. There are three things that I think really differentiate NextEra as part of our value story. One, we're seeing an inflection point in power demand. Two, it's going to be met by renewables because it's low cost, fast to deploy, and it's clean. And no company's better positioned to meet it than we are. And our business model has always been what I would call a replacement cycle. We're building new renewables to replace higher cost coal plants, higher cost, less efficient gas-fired units, oil-fired units. We now have this new opportunity that's really emerged in the last 6 to 9 months, which is what I call our growth cycle opportunity. It's a new demand that has come, and it's across industries. It's not just data centers get a lot of discussion, but it's industrial electrification, reshoring and manufacturing as well. But when you think about it, we're having all these discussions with these customers now. Take data centers, for example. It takes 2 to 3 years to build a data center, so they won't need the power until 2027. We might sign a contract today, but the power comes in 27, which means it contributes in 28. And so what we're trying to explain to investors yesterday is, look, we have a tremendous long-term growth outlook, but a lot of this growth cycle demand is really going to start materializing and producing revenues and earnings in 27, which means it really starts to contribute in 28.
As you walk through Midtown Manhattan, you probably see some empty office space here. I think they all moved down to your state. Talk to us about how that's impacted your business in terms of demand and maybe what you have to invest back into your grid.
Yeah, and that's what's great about our business, right, is the barbell approach. We've got the nation's leading rate-regulated utility in Florida and the world's leader in renewables. In Florida, we're seeing tremendous growth. Over the next 20 years, we're projecting a 44% increase in GDP. We have 1,000 people a day moving to the state of Florida. 4 of the 5 fastest growing metropolitan areas in the United States are in Florida. If Florida were a country, it would have the 14th largest economy in the world. And we're there to power all that growth. So our growth story is not only about what I just discussed about all this renewable demand that we see powering AI and industry and manufacturing across the United States, but it's also all the growth that we see right in our own backyard in Florida.
Talk to me about rates. So you're going to need to invest a lot, right? Like there's going to be an enormous investment cycle, as you mentioned, like the growth cycle for utilities, right? What is it like on the regulated side of going back to the government and saying, okay, guys, I got to invest it. You got to raise the rates.
Yeah, and so what we do is we have done a terrific job of taking cost out of our business. So when you look at what we've been able to do over the last 20 years, our O&M on a dollar per megawatt hour basis is 70% lower than the national average. That's $3 billion we put in our customers' pocketbook every single year compared to an average utility. And we've always been able to make really smart capital investment decisions around bringing low-cost generation into the fold. And today, the lowest cost generation option that we have in Florida is solar and storage. So although we're investing more capital, it's actually lowering the bill because it's a lot cheaper than other generation alternatives combined with our ability to take cost out with the way we operate.
But from your investor's perspective, is a unit of power from a renewable source, what's the profit margin on that versus maybe an existing source?
Well, when you think about renewables, I mean, renewables, have really strong returns. And they're low cost, and you talked about, interest rates, being one of the factors. We pass those costs through to our customers. And so the cost of wind and solar has gone up a little bit as we've seen some pressure, here from the macro environment, but so have cost increase for every other type of generation. Actually, gas-fired generation has really gone up in price. And so, what we have seen with gas-fired technology is a 50% increase in the last 12 months. That has not happened to renewables, making renewables even lower cost than they've ever been on a relative basis to gas turbine options.
So what I hear is that everything is just more expensive because that's the environment that we're in. But because you're able to take costs out, the ratepayer may not get hit as hard. Is that a fair statement?
That's exactly right. And so what we've been able to do in Florida, our bill is 37% lower than the national average. 37%. It's because of our ability to take all those costs out of the company and also offer them low-cost renewable solutions as part of the generation mix. And when you put those two together, that's how we're able to achieve that 37% lower bill than the rest of the nation. That's a really compelling customer value proposition and investor value proposition.
Man, I have like 75 more questions. We didn't get to nuclear. We didn't get to, hydrogen. Okay, you're coming back, John. This is so helpful. And you're really in those two parts, like the here and now and then the future. And I think that's just so fascinating. So definitely come back. We'd love to further the perspective. John Ketchum, President and CEO of Next Era Energy, based in Florida. Great to see you. Okay, coming up, David Kudla is founder and CEO of Chief Investment Strategist at Mainstay Capital Management. He's going to join us on his call on the Fed, his call on the markets, as we're right around these record highs for the S&P. It is like all systems go. Everything's kind of awesome. That's from Savita Subramanian over at Bank of America. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 topping 5,400 for the first time. Gains being led by its most influential group, technology. Right now, NASDAQ is up 326 points, an advance of 1.9%, bringing the year-to-date gain for NASDAQ to 17.5%. S&P up 64 to 54.39, up 1.2%. The Dow up 147, up by about 0.4%. Stocks hitting records as a cool down in inflation spurs a plunge in bond yields. 10-year 4.26%, the 2-year 4.68%. Gold up $10.50 the ounce to $23.27, up 0.5%. West Texas Intermediate crude oil up 0.2%, $78.09 a barrel. Oracle reported better than expected bookings and announced partnership deals with tech rivals, giving a boost to Chairman Larry Ellison's effort to redefine the software maker as a major competitor in the business of cloud computing. We've got Oracle shares surging now by 10.6% at a record. Also at a record, Apple up another 5% today. Again, S&P at a record, 54.39 right now, up 64, a gain of 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, and we're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. As Charlie was just reporting, S&P at record highs. Just a big, I think, embrace by the marketplace and risk assets on what we saw was a little bit cooler than expected inflation data. Couple that with a Fed meeting this afternoon. A lot of folks are taking this as an opportunity to jump into the market. Let's check in with a professional on this whole thing. David Kudla, founder, chief executive officer, and chief investment strategist at Mainstay Capital Management, joins us. David, the market likes what it heard this morning, I guess, anticipating an accommodative Fed going forward. What's your take?
I think that's exactly what we're seeing. Good morning, Paul and Alex. Here's the quandary, right? We have an inverted yield curve for the longest in history, and an inversion very deep that is 8 for 8 on predicting a recession. We have these stats out there: credit card interest rates at an all-time high, delinquencies at an all-time high, auto loan defaults rising rapidly. That is anecdotal data pointing towards problems in the economy. At the same time, we had positive GDP in the fourth quarter, first quarter, and GDP now from the Atlanta Fed is currently above 3% for the second quarter, and that's a very volatile number. Earnings are beat expectations by a wide margin for the first quarter. We're expecting good earnings for the year. We're out of the earnings recession, strong earnings going forward. And the S&P Global PMI has manufacturing and services at 24 and 25-month highs. So there is a lot of conflicting data out there as to where the economy is at right now and where the economy is going. And as far as the Fed, we saw another slight decrease in CPI, and we know though that it's going to be, Powell is. We'll see what we hear in the presser today and what kind of guidance we get, what the dot plot shows. But we're seeing inflation being sticky. Even their preferred gauge, services PMI, is at 2.8. They're not at target yet, and inflation is remaining sticky and stubbornly high.
So you think the Fed eventually today takes away that punch bowl by sort of pouring some cold water here?
Well, I think that and it's become a parlor game, like calling the level of the S&P 500 at the end of the year as to when the Fed will cut. And we see economists and wirehouses with each data point jumping back and forth between July or December or September. But we see the fact of the matter is until it's clear to the FOMC that inflation or CPI is getting close, or PC is getting close to their target, they're not going to cut. They're not going to cut. And there's plenty of economic data they can point to that says the economy is really doing okay, although there's some economic data out there that scares the heck out of me.
So given that backdrop here, how are you thinking about your portfolio construction? What kind of tweaks have you been making maybe over the last several months? What do you anticipate maybe over the next several months?
Well, and that's what we haven't really. We've been on the equity side. We continue to favor large cap over small cap, and we've seen that valuation spread keeps setting multi-year records as well. Large cap over small cap, U.S. over foreign, growth over value. Growth over value being and large over small being very important. Mega cap tech continues to rock and roll. Look at what we've got today. I mean, how many people have come on the show and talked about shorting the mega cap stocks over the past year?
No one.
No one?
No, I haven't heard anyone saying short the mega caps. No way. That's like standing in front of a train.
Oh, well, I agree with you, but we have. I mean, we have. And likewise on the income side, how many people have come on the show and said they're adding duration because the Fed is going to cut rates? They've had their head handed to them. The U.S. aggregate bond index is negative year to date. And what we've been saying is that where you want to be in a 60-40 portfolio or whatever the income oriented portion of your portfolio is, has to be an ultra short maturity, high yielding with zero duration risk. That produced about a 7.5% return last year with those types of ultra short bond funds, about 3.5% this year versus a negative U.S. aggregate bond index. So that strategy, that combination of leaning towards large cap growth on our equity side, ultra short, high yielding, zero duration risk in our bond funds, ETFs, bond allocation, has continued to work very, very well.
And David, you mentioned the U.S. Ag bond index, the Bloomberg index, down 0.9% year to date. But are you surprised that the U.S. corporate high yield is actually up a couple of percent here and has been outperforming really over the last couple of years, given concerns about a recession? Are you surprised that the high yield market's done as well as it has?
Yeah, I mean, credit spreads are tight, and we don't want to be high yield with long duration, right? We're talking about where we're holding high yield, where we're holding bank loan, where we're holding floating rate. I'm talking about an income portfolio or a credit debt portfolio with a duration of about 0.1, not 5 or 6 or 10, right? So we want to, in each of those categories, we don't want the duration risk. We're not ready for that yet because, look, we think, I said it in my notes, and I'll continue to say it, the first Fed rate cut is months away because they're nowhere near target or they're still far enough away on the target. We had a slight improvement, in this release. But they've got a long way to go unless they change their target to get to 2%.
I know this is sacrilege, like a couple hours before the Fed, but what about ex-US? With the ECB having already cut, but the politics situation there is really upended in France, and also the UK. Anything overseas that strikes your fancy?
Yeah, a good question. When we look abroad, Europe, whether the ECB should be cutting yet or not, they cut a quarter point. In Japan, we've loved Japan for a long time now, with the weakness in the yen, just tremendous for their exporters, other corporate reforms. Japan we've had an allocation to. With all of this, you have to be very careful to hedge the currency because what's happening with the Fed staying tight, ECB cutting, what's happening with the yen, you don't want that. You don't want FX affecting your return. You need the currency hedge in there. But yeah, we're seeing more and more opportunities abroad in that respect. That's why I said our growth over value, our large over small is the important part. U.S. over foreign. I still think it's America first, but there are opportunities abroad, specifically Japan, and I think coming on in Europe now.
All right, David, thank you so much for joining us. David Kudla, founder, chief executive officer, and chief investment officer, Mainstay Capital Management. Appreciate getting a few moments of his time sticking with the large cap growth names, and I guess why not? That's kind of where, you know, we've seen all of the action. You think about some of the performance. I've seen some charts from some folks, you know, and some work done. You know, the percentage just from NVIDIA itself in terms of the gains in the S&P.
30%, I think, of all the gains.
30 some odd percent.
There was well, we were just talking. Who were we talking to? Oh, Anurag, who was saying that Oracle is doubling its capex.
Yeah.
I mean, and he said those numbers are real.
Yeah.
So if those numbers are real, this is a serious reinvestment cycle, an investment cycle that we're in the U.S. As long as that flow comes, it's going to be hard to step away from the guys that are doing all the work.
Yeah, it really is. I mean, it's you know, and we had a guest in here earlier who actually, she is an economist, but she's saying in her PA, personal account, she's long NVIDIA, and she was saying, you know, think about trimming some, and I'm like, why? I mean, I get it, take little profits, okay, but maybe we're just not seeing that. We're seeing these stocks continue to move higher. Again, the NASDAQ today up 1.8%, up 1.9%. And the Russell also putting up some performance there. Yields coming in. Let's look at the two-year Treasury off 15 basis points, 4.68% for your 2-year. The 10 years at about 4.26%. That's off 14 basis points. So movement in the bond market. With our news in New York City.
Thank you very much, Paul, Alex, and Shirley. Hamas has now officially responded to the latest ceasefire proposal for Gaza. Secretary of State Antony Blinken in Qatar today said the U.S. is studying the response. Blinken says Hamas's position means the war that began with the group's attack on October 7th will go on.
The response from Hamas. Numerous changes proposed to the deal that was on the table and that the entire world has gotten behind, but some of those are workable changes.
Secretary Blinken said the U.S. is determined to try to bridge the gaps. The United States widened its sanctions against Russia today as G7 leaders prepare to gather in Italy for a summit where the top priorities will be boosting support for Ukraine and grinding down Russia's war machine. Today's package targeted Chinese companies, which help Russia pursue its war in Ukraine and raise the stakes for foreign financial institutions, which work with sanctioned Russian entities. The U.S. has sanctioned more than 4,000 Russian businesses and individuals since the war began in an effort to choke off the flow of money and armaments to Moscow. Even as they prepare to vote on a formal ban on churches with women pastors, delegates to the Southern Baptist Convention annual meeting in Indianapolis voted overwhelmingly to expel one such church from its ranks. Messengers, as voting representatives are known, voted overwhelmingly to oust First Baptist Church of Alexandria, a historic Virginia congregation that affirms women can serve in any pastoral role, including as senior pastor. Beth Allen Barr is a religious professor at Baylor University in Texas.
This is fundamentally about if women are recognized as fully equal, as fully in the image of God as men are.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. CPI Wednesday, a Fed Wednesday, stocks trading at records. We have got the S&P 500 index topping 5,400 for the first time, with gains being led by its most influential group, technology. Right to the numbers. S&P up 61, 54.36, up right now by 1.1%. We are off session highs. The Dow up 0.2%, up 81 points. NASDAQ up 322, moving higher by 1.9%. 10-year, 4.26%. The 2-year, 4.67%. Spot gold up 0.9%, 23.36 the ounce. And West Texas Intermediate crude up 0.2%, 78.09 for a barrel of WTI. The Consumer Price Index this morning showed no change in May, the tamest showing in almost 2 years. And with more, here's Bloomberg's Vinny Del Giudice.
Price increases moderated across the board, and that could be a pleasant surprise for Federal Reserve officials looking for signs that they can start lowering interest rates. They're meeting today in Washington, but no change in policy is in the cards just now. Case in point, year-over-year, the CPI is running at 3.3% above the Fed's 2% target. There's a ways to go. Vinny Del Giudice, Bloomberg Radio.
Again, the 10-year yield, 4.26%. The Wall Street Journal is reporting that SpaceX CEO Elon Musk pursued women working at the company for sex, including a former intern. The Journal, citing affidavits signed by one of the women and other interviews, former SpaceX executives told the Journal that company policies are not enforced with Musk. Again, recapping, U.S. stocks push higher, trading at a record. Both Oracle and Apple are at records right now. S&P up by 1.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie Pellet. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and economics and finance with our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries all around the world. One top news item here, and so interesting that it comes on the day of the shareholder Tesla vote, which should come tomorrow, is the European Union's decision to put tariffs of up to 48% on EV imports from China. It just escalates trade tensions and adds to the cost of buying an EV. Craig Trudell is Global Autos editor for Bloomberg News, and he joins us now from London. I got lots of questions on this one, but broad strokes, what are the details with these tariff increases?
Yeah, this is huge news. It was anticipated, but the particulars are something that are very fresh. So the European Union launched this investigation last year into the extent of the subsidization of electric vehicles by China, which are increasingly, coming into Europe and, really able to compete with local manufacturers. There's been concerns about, Chinese cars being able to undercut companies like Volkswagen and Stellantis and Renault. The details here today, SAIC, the maker of MG, which is a British brand that was sort of brought back from the brink by a state-owned company in China, SAIC, they are going to be subject to a 38% additional tariff. And MG's really been sort of lighting things on fire here in Europe and in the UK in terms of really, being able to push a lot more volume the last couple of years. Another big manufacturer that's going to be subject to a substantial tariff will be Geely. They, of course, own Volvo and Polestar and some other big brands. BYD is another company that will be subject to 17% additional tariff. And the rest of the industry will be subject to a weighted average duty of 21%.
So talk to us about just the EV market and China's percentage. Like, what's China's market share in Europe of EVs broadly defined? Because you can't find one here in the U.S.
Yeah, I mean, it's tricky because it, of course, depends a little bit on how you define it. And I think one of the things that's really interesting here is that it's not necessarily just Chinese companies that are doing this importing. The biggest importer, as a matter of fact, is Tesla. They have the plant in Germany where they make Model Ys, but they don't make Model 3s there. So they've been shipping an awful lot of Model 3s from their plant in Shanghai They interestingly are going to try to have a lower duty rate and make the argument to the European Commission that because they've been benefiting less than other manufacturers from subsidies, that they should have a sort of commensurate duty rate. Other manufacturers are able to make that request and have what's called a individually calculated rate, but if at this juncture, the only company that we know that's asked for that and may get it is Tesla.
Here's what I don't quite understand, and I know I'm kind of beating my head against a wall on this one, but if the goal is to go green, why wouldn't they want to flood the market with a ton of Chinese EV imports and get the green stuff going? And I appreciate that they want to protect their car manufacturers, but importing cheaper EVs also spurs competition. So the line to thread the needle I find to be very confusing.
It's absolutely needle threading or tightrope walking, pick your metaphor, and it is a very valid question. And depending on who you ask, they're doing absolutely the right thing here, or they're really sort of shooting themselves in the foot, folks in Brussels. The debate here is to what extent do local manufacturers need to be protected from the fact that China has jumped out to this huge lead. They're dominant in this space. They're able to, bring electric vehicles to market with much cheaper batteries that people can actually afford. And that's been, the major, sort of pain point for the industry is they have not been able to bring prices down far enough, fast enough for, more mass market adoption. China's been able to pull that off. In large part, European companies have not been able to do that. So while, we've seen quite a bit more momentum in Europe relative to say, the U.S., that momentum has really slowed of late, particularly as we've seen, the cost of living crisis and inflation really hitting consumers' pocketbooks. We've not seen, the growth rates that, just in the last few years were really eye-popping and getting a lot of people excited about, this transition being doable.
So that's kind of where I wanted to go, Craig, because here in the U.S., there really seems to be a palpable, decline in the adoption rate for EVs, and people debate whether it's price, whether there are some political issues out there, whether there's lack of adequate charging infrastructure, whatever, but there's been a palpable, kind of sense that the market's cooling off. Give us a sense of how the market is in the UK and the EU.
Yeah, I would definitely recommend that listeners take a look to the extent they have access to the Bloomberg Neff's report out today, their annual EV outlook. It really goes into great detail on just, sort of the ins and outs here. What we've been seeing is, one manufacturer after another coming out and really sort of dialing back their ambitions. Mercedes just a few years ago talked about being able to maybe go fully electric, around 2030 in certain markets. They've really walked that back. You've seen Ford and GM and Volkswagen, even Tesla, put off or sort of indefinitely delay factory investments. Tesla, of course, made a big announcement about building a factory in Mexico that is very much on ice. Volkswagen canceled a plant in Germany. There's just a lot of concern among manufacturers about being able to profitably make affordable electric vehicles. And again, the way in which the Chinese have been able to achieve this has been driving down battery prices. And that's one of the most compelling things in this report for me is just the amount of capacity that we've seen in China. So when you want to talk about competition and fairness, that's something that Brussels and Washington they really highlight as what's problematic here is that they're essentially making the case that China is flooding the market and artificially driving down prices. That's good for the consumer, but risks putting their companies out of business, or if that's too extreme, at least at a significant disadvantage.
Craig, really appreciate it. Thank you so much. Craig Trudell, a Bloomberg Global Autos editor, joining us there. Yes, and that Bloomberg NEF report that comes out is widely cited by most auto analysts on the street. It's really seen as the definitive EV demand outlook and supply outlook. So if you can get your hands on it in any capacity, you should definitely do so. And it feels like a chicken and an egg thing. You need the supply, and then you need the demand. And the chicken and the egg, there you go. There's still more coming up because I'm going to tell Paul how to throw a party in daylight in summer. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
Bloomberg World Headquarters. I'm Charlie Pellet. We've got the U.S. stock market trading at records. S&P topping 5,400 for the first time. Apple shares also at a record, up 4.6% right now. Apple at $216.74, overtaking Microsoft in market cap on an intraday basis, with the iPhone maker regaining its title as the world's largest stock amid growing optimism that artificial intelligence will spur a rebound in revenue growth. The stock has also been supported by a positive quarterly report in early May when Apple announced the largest stock buyback program in U.S. history at $110 billion. Right now, we've got Apple again up by 4.7%. Also at a record, Oracle. After last night's earnings report, Oracle reported better-than-expected bookings and announced partnership deals with tech rivals, giving a boost to Chairman Larry Ellison's effort to redefine the software maker as a major competitor in the business of cloud computing. Anurag Rana is a senior tech analyst with Bloomberg Intelligence.
Prior to going into the quarter, there is a lot of noise about software spending slowing down, but that's on the application side. That's a different kind of the business. But on the infrastructure side, where you're hosting somebody's application or a workload, that business is still doing well. So it's good for Amazon, it's good for Microsoft, and now it's actually good for Google. Oracle also.
And that's Bloomberg's Anurag Rana. We've got Oracle surging today after earnings, up now by 11.4%, again at a record. And Blackstone finalizing a deal to expand its Manhattan headquarters space in one of the city's largest office leases in recent years. Blackstone, located on Park Avenue in Manhattan. Those are our top company stories, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. Happy CPI and Fed Day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got all the news that you need to know in the world of business, economic, and finance, and also we get you world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex. Paul, Charlie, Secretary of State Antony Blinken said Hamas demanded several changes to a ceasefire proposal that go beyond the group's previous stance. Blinken told a briefing in Doha Hamas's position means the war will go on.
Hamas has proposed numerous changes to the proposal that was on the table. I believe those gaps are bridgeable. Doesn't mean they will be bridged. We are going to continue to push on an urgent basis with our partners, with Qatar, with Egypt, to try to close this deal.
Secretary Blinken is concerned it casts fresh doubt about the chances for a deal anytime soon. The full House is voting today on whether to hold Attorney General Merrick Garland in contempt of Congress. House Republicans have been demanding that the Justice Department turn over audio recordings of President Biden's interview with Special Counsel Robert Hur. The interview is part of Hur's investigation of classified documents found in Biden's home and office. Garland has provided a transcript of the full interview, but not the audio. Some Republicans believe the transcript differs from the recording. Democrats say Republicans just want the audio to use in anti-Biden ads. Meanwhile, Garland addressed the Elder Justice Coordinating Council at the Justice Department. He says elder abuse is a widespread problem, especially when it comes to fraud.
As we confront the expansion of transnational fraud schemes and the rapid advancement of AI, we must work together to make sure that older Americans can live their lives safely and with dignity.
Garland went on to say they had provided services to more than 1.5 million older victims. President Biden is on his way to Italy for the G7 summit. Biden is expected to propose a $50 billion loan for Ukraine funded by profits from seized Russian assets. Finally, NBA legend Jerry West has died. West was selected to the Basketball Hall of Fame 3 times in a storied career as a player with the Lakers and an executive. His silhouette is considered to be the basis of the NBA logo. Jerry West was 86. Global news 24 hours a day and whenever you want it. With the Bloomberg News Now, I'm Michael Barr, and this is Bloomberg. Paul, Alex, Charlie.
All right, thank you so much, Michael Barr. So here's the deal. If restaurant inflation is too much, you don't want to go out to eat, can't get a reservation, prices are too high, it's summer, you picnic. Now, we're not talking picnic like let's just grab some burgers and like head to the park. Let's talk about a high-end picnic here. First of all, not only do you need your music, but consider a disco ball. This is according from a great piece in Bloomberg Business Week, so keep that in mind. Putting the disco ball aside, they have 27 ways to supercharge your picnic. And I'm talking like an oyster cooler.
Oyster cooler. That sounds useful, I guess.
I mean, bring your oysters,
Bring
right?
your oysters, yeah.
A lobster bottle opener. So you have it's just like a cool little designery thing that you can bring. Obviously, all your sparkling cocktails, and now they make all those in like cans and stuff.
They do that.
So that helps.
So just a big tub of ice and cans of Budweiser and some burgers on the grill. That's not going to cut it.
That's done. No, you got to step up your game if you can't go to the latest bistro that's super cool. And forget that tap water. Get your sparkling coconut water.
Really?
Yeah. I mean, no, for me, but you know. And then if you don't, you're not going to go and get your lobster or surf and turf. You can get high-end canned seafood.
I think this is like Hamptons-ish.
Yeah, I'm not doing it, but
this is Hamptons-ish, right? Okay.
Yeah, this is like a whole different level of.
This is not Jersey Shore. Let's just be honest.
I mean, you could elevate your beach picnic
could
to
elevate
this.
the
Like,
game.
you could make this a thing.
Yep.
That you can also get different types of wine, like a rose blood
Now you
rosé.
get my attention a little bit.
Okay, so a 2022 Chateau d'Estoublon rose
nice.
blood rosé,
Yep.
$23.
Okay. Well, it's rosé. The time of year to drink rosé.
You got it. You gotta do it.
But the only time I drink rosé was when in the south of France. Did that twice. They drink it from morning till night.
It's so good. I mean, that's their water. That's their sparkling, and then they have the red at night. Anyway, that's how we leave you. And the disco ball. Don't forget that. Balance of Power with Joe Matthew is up next. This is Bloomberg.
world of politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Consumer prices cool. So what does it mean for the Fed and for Joe Biden? Welcome to the fastest show in politics, with May data out this morning showing inflation slowing on this Fed day in Washington. We've got a lot to cover with the help coming up of Bloomberg economics editor Molly Smith. Insights coming as well from economist Lindsay Owens at the Groundwork Collaborative as we walk our way up to special coverage and a Fed rate decision just a couple hours away. The president on his way to G7 in Italy right now. We're going to talk about the agenda and what the summit could mean for Ukraine and Israel with Lester Munson, Republican strategist from BGR Group. And we'll walk through the primary results from last night and some races to watch with our signature panel. Rick Davis and Jeannie Shanzano are with us. And we start, as always, on Wall Street with a look at stocks, the markets today on this Fed day with Charlie Pellet. Hey, Charlie.
Hi, thank you very much, Joe Matthew. I've got you covered. Lots going on, both on Wall Street, also in Washington. It is CPI Wednesday, a Fed Wednesday. Stocks hitting records, as you mentioned. S&P crashing through 5,400 for the first time, led by gains in its most influential group, and that is technology. We've got NASDAQ up an even 300 right now, up 1.7%. NASDAQ 100 index up 1.4%. S&P at 5434, up 59 now, up 1.1%. And the Dow Jones Industrial Average up by 101 points, up by 0.3%. 10-year 4.26%, the 2-year 4.68%. Gold up 0.8%, 23.35, and West Texas Intermediate crude up 0.5%, 78.26 a barrel. So the CPI report, the opening act. Right now we're in the intermission, and perhaps the big thing happens this afternoon, 2 o'clock when the decision comes down, but 2:30 p.m. when we get that news conference from Fed Chair Jay Powell. Yes, you can catch it live on Bloomberg Radio. Reaction to this morning's CPI print from Jim Bullard, Dean of the Purdue Business School and former president of the St. Louis Fed.
I think this was good news for the committee. They've been looking for a softer report. They got it here, but the typical reaction would be, okay, this is good, but this is 1 month's numbers. We would need more news going in this direction in order to forge ahead with our easing policy.
Former St. Louis Fed President Jim Bullard. So again, recapping, stocks are pushing higher. Speaking of records, both Apple and Oracle after earnings. Oracle reported last night. Again, the S&P up 1.1%, and that is a Bloomberg Business Flash. Joe?
All right, Charlie Pellet, we thank you walking us through the markets on a very important day here. Double risk is what I was reading about this morning. And we just checked one of those two boxes, waiting for, I guess, single risk with the Fed meeting, and that's coming. We have special coverage planned for you. But the news at 8:30, my goodness, everyone's happy. U.S. inflation broadly cools, an encouraging sign for Fed officials. I read on the terminal, White House seems pretty happy about it. Markets seem pretty happy about it. See how Molly Smith feels about it. She was up early. If you want to get on the terminal, by the way, Molly Smith is the gatekeeper. If you cover economics here, she is Bloomberg's economics editor. And, you know, CPI day is one thing. With a Fed day on top of it, we're lucky that you made time for us, Molly Smith. Welcome back. Do you drive a car? I know you live in New York, right?
Come on.
Well, I like, God, you could, gosh, be just about anywhere. Are you coming in from the suburbs? You live in New York, you don't have a car. Is that right?
I don't drive, and I live very close to HQ, so I'm right here for the action.
You're really smart. As I, spend an hour to get to work every morning, although I don't live above the store. They can't call me at night the way they do you or first thing in the morning. And I'm asking you about this because of these crazy prices, not only for automobiles that we've been talking about, but auto insurance up 20%. Is this the number that distorts the CPI today? How is that even possible?
So actually, we've been looking at it more from the monthly change in car insurance. What you were citing correctly is the annual pace that car insurance is up 20% year over year. It has been one of the bigger drivers of services inflation.
Did it come down from last month?
What's that?
Did it come down from last month? Is that why you make the difference?
Correct, yes. So this was the first month in, gosh, I think it was over 2 years maybe. You'd have to check me on that. The car insurance fell in the monthly rate, that is. So look, obviously actual prices still definitely high, not discounting that whatsoever. But when you're looking at directionally, if this is maybe a sign that this is going to start easing more going forward and not contributing to more outsized readings, that could be very significant.
So if you're looking at the more broad picture here, and you're, say, Joe Biden, hoping for an interest rate cut, and we're going to talk more about that coming up in a minute as well, what has you encouraged about this reading? I mean, we're celebrating over 0.1% essentially here, right?
Well, it's a lot of things. You know, it's not just car insurance. This was a really broadly positive report, no matter if you're at the Fed, if you're Joe Biden, American consumers. It really had a lot of good news for a lot of people that where we have seen so much of the inflation pressure in the last couple of years has been from services, and that's where we finally got to see services prices coming down. Car insurance was a big one that has been, like we said, going up for so many months, and we also saw airfares come down. That was significant. Some other travel-related expenses as well. Well, the next one that we're really all waiting for and that economists are getting more conviction is going to show up in next month's report is that long-awaited slowdown in housing inflation. That has still really yet to materialize, so we're hoping that the June CPI is going to be the first real look at that.
So core CPI up 0.2 from April. Market expected 0.3, is that right? But that, I mean, this is the sliver we're talking about here, right?
Right, and if you want to get even more to a narrower sliver than that and get really wonky with it, as our readers like to, then you're going to look at it out to 2 decimal places. So this was actually up 0.16%. So that rounds up to 0.2 versus, let's say, if it was 0.24 and rounded down. And that's really significant because let's try to annualize that rate. 0.16 multiplied out over 12 months is a 1.92 pace of inflation. That's under 2%. That's the magic number that we're looking for.
That's why I would have copied off of Molly's homework in high school.
Couldn't you do that one in your head? I didn't either. I did it before I came here.
Well, you've got a terminal, by God. Connect the dots for me on this Fed meeting. Molly, they're not making decisions today, I'm sure, based on this alone. But in the grand scheme, when we talk about the dot plot, how does this factor into it?
Right, yeah. I mean, this was already, we were wondering about how the dots were going to shift from the March quarterly projections to now. And after we had seen all of those really hefty inflation prints at the start of the year, and that's when the Fed was thinking there would be 3 rate cuts in 2024, everybody's thinking, okay, that's now got to be down to 2. This report really helps solidify that, like, there are probably 2 rate cuts that could happen this year, and investors in the market reaction today even more bullish that those could start to come sooner. So right now, the first fully priced Fed hike would be in November, which is consequently 2 days after the election.
Consequently, and we're told they don't play those games, right? If it's too close to the election, that might be part of the factoring in, although the Fed wouldn't acknowledge that, I'm sure.
Correct,
but that's
yes.
kind
I'm
of hard
sure
to
that
ignore,
would come up in Jay's press conference today, and we will all be very much listening.
Michael McKee's in there crafting a question that I'm sure the chairman will have to stop down and think about. And Molly, it's great to have you. We appreciate your joining us. Molly Smith, Bloomberg economics editor, spends more time on Bloomberg Radio than I do. She's that good. This is a very important day in Washington tomorrow that you might not have heard about, maybe if you're not inside the Beltway here. An important thing called Seersucker Thursday. It's happening on June 13th this year. And I bring this up because if you're with us right now on YouTube, you can close your eyes if you're listening on Bloomberg Radio or in satellite radio. The great Lester Munson is prepared for Seersucker Thursday. You're a day early, and it's nice to see you in the studio here.
Thanks, Joe. On K Street, we like to do it a little bit. We like to be ahead of the curve.
Yes,
the Senate,
you are.
The Senate's going to be on Thursday. Okay. We're out there today.
K Street does it today?
Way.
Is that
We're
really how it
leading
works?
the way, baby.
I have so much to learn from you still. He's the co-head of the international practice at BGR Group and spent some time on the Senate Foreign Relations Committee as an important staff director. Another thing starts tomorrow. That's the G7.
Yeah.
Funny how that coincides. Joe Biden's on Air Force One right now, heading over there. With your acumen in foreign policy, I want to get your take on this, because we have two hot wars going that this president is trying to balance, and he has the opportunity to sit down with our most important allies the next couple of days to try to move the ball on both of them. Does it help? We'll pick through those, Ukraine and Israel first. How about that? Does it help with the potential for a ceasefire, for him to be in the same room with his G7 allies?
Well, I think it can. And is he nimble enough to use this as an opportunity to drive a message and show strength in the international community? There's a higher degree of difficulty today than a few days ago. The European Parliament elections were just a few days ago. The right wing did really well. That's going to be the mood with the Europeans at the G7. Prime Minister Meloni, who is hosting, is kind of the spokesperson for that. So she's going to have a prominent position. There's a mood of change afoot. Can Joe Biden kind of turn that to his advantage? It's hard as the incumbent. He's got some real challenges, but this could be a real good opportunity for him to show some foreign policy chops.
He got a bit of a running start in Normandy last week. He was in the same room with a lot of the same people he'll be talking to now, including Emmanuel Macron, to your point, bruised up a little bit in the elections over the weekend. But also President Zelensky, he's going to be holding a bilateral news conference. I suspect it'll land right in the middle of this show tomorrow. As a matter of fact, we'll bring it to you as it happens from overseas. Ukraine is something, of course, that's in the air, but we've cleared funding here in the U.S. What's the next hurdle for Joe Biden on Ukraine?
So Ukraine has been using some of our new aid and some of the new kind of longer leash from Biden to start striking at supply lines inside Russia. That's a big deal. And now we see as kind of a tit for tat, Russian ships coming into Cuba in our backyard, a little bit of a violation of the Monroe Doctrine if you want to go way back. So can Biden double down with Zelensky? Let's punch the bully in the nose. Let's go after the Russians. Let's show them that we're undeterred here by what they're doing in the Caribbean, and that we're gonna bring the fight to them in Ukraine where it really matters. So again, big opportunity for President Biden.
Seizing of Russian assets, I suspect, is on the agenda. Remember, the president signed the Repo Act into law, same time he passed the funding for Ukraine. But the bulk of that money, we're told, is in Europe. So this sounds like an important conversation this week.
It can be. I think they should keep expectations low. There's going to be a lot of legal impediments to freeing up that money to use it right away. It's probably going to be a few years before we really see it being used.
So that's the rebuilding of Ukraine, not the war effort.
That's right.
What's the problem? Why is it so hard to do this when everyone seems to be on that side?
It's harder than it looks, right? The people are going to lawyer up these assets. They're very valuable. The president can't just go grab them. We are nations of laws here in the West, which is our wonderful asset, and occasionally it's a bit of a problem. In this case, it might be a bit of a problem.
You mentioned offensive weapons. That is the big development, I guess, most recently, but it's isolated around Kharkiv for the most part, where it appears that Ukraine has been on the ropes. There have been interesting comments we've heard from the likes of Emmanuel Macron and others to say, hey, maybe you want to use European weapons. And in some cases, Ukraine has been taking them up on that. Are we on the same page with our European allies, and are we going to see a widening of that offensive posture?
It's a great question, Joe. The Biden administration has been letting Europeans kind of push the envelope in terms of what weapon systems are being used. It was Europeans and the British who were pushing for more tanks, for more jet aircraft, longer range weapons, and the Biden administration made it appear like they were kind of going along reluctantly with that. I think that's intentional to give the Europeans some agency here, which can be a very good thing. But so I'm hoping that's what this is, and there isn't a real delta between the U.S. and Western Europe here.
Well, it's interesting when you step back then and look at this G7, how much of this is photo opportunity versus policy?
Sometimes the photo opportunity is the policy.
Yeah,
the appearances matter here. Can the president show some vigor and some nimbleness and get the Europeans to show they're supportive of him? Can they hold off the specter of, if you will, of kind of an ascendant right wing in both Europe and the United States? They're going to have to look like they've got energy and they can solve problems. Can they win in Ukraine? Can they get to a negotiated settlement in Gaza? Can they show results for their efforts? If not, people are going to vote for change.
So this is an important summit. And the optics behind it for this president, he's probably getting a good nap on the plane right now, right? This is exhausting. For a young man, this would be exhausting. They're putting him down the short stairs now to eliminate the chance of a stumble. This is part of the calculation for this White House no matter where he's going.
Low expectations. If he can walk off the stage in the right way, in a straight line,
that's all I
he's
ask for
gonna
my
win.
own self, to be perfectly honest. So I mentioned your time on the Senate Foreign Relations Committee. There's discord over the ICC. Getting back to where we started with Israel here, this is the International Criminal Court, arrest warrants, right? We heard for Benjamin Netanyahu, along with the leaders of Hamas. And there was a move to have a resolution essentially condemning the ICC. And it's not a layup. Why is this controversial within the Senate Foreign Relations Committee, and will it die there?
So I think Senator Risch, who's the ranking Republican there, who's kind of the instigator of this, is actually in the right place. He's taking a bipartisan bill from the House. He wants the Senate to move it. Senator Cardin, who's the chair of the committee, has said, well, I don't think it's bipartisan enough. I don't like the methodology, but I'll continue talking to you. And Senator Risch is kind of holding his feet to the fire, saying, all right, I'm going to slow down some of these other things until we get this thing resolved. This is the hot item. This is what both parties care about. And poor Senator Cardin has to kind of defend this little bit schizophrenic policy of the White House.
Is it bipartisan?
It passed House with a lot of Democrats. There's several Democrats in the Senate who want to move this thing.
So this could see the light of day.
I think it will at the end of the day in some form, whether it goes through the committee on some sort of compromise or they attach it to something else. There's just a lot of energy in Congress. It's playing out in other committees on other legislation. Congress wants to support Israel. They see Israel as very much the victim of Hamas and the positions of Hamas as utterly untenable. They're going to continue pushing until this thing is over.
We just got a minute with Lester Munson, but I have to ask you, with that said, about Benjamin Netanyahu paying a visit. That's going to be quite a day in Washington with some very sensitive feelings on both sides of the aisle. He will be addressing a joint session, it seems. What's the potential boycott list going to look like?
Let's remember, he was invited by the Speaker, Speaker Johnson, and the Minority Leader in the House, Hakeem Jeffries, and Schumer, and McConnell. So this is a bipartisan, bicameral effort. Yes, it'll be a little bit controversial, I think, particularly for progressives. There may be some on the far right.
There's no ceasefire by then?
That really is the big question, Joe. Like, can the Biden administration get to a place where whatever's going to happen happens before the address? That will make it much more successful. And if that doesn't happen, then I think we are looking at a real hot topic.
I'll be curious to see if there's a White House visit and if there's gloating when he goes home, because that's a big score for Benjamin Netanyahu to do.
There should be a White House visit.
The layup here, We'll talk more about it then. Great to see you. Searsucker Thursday. He's a day ahead. That's how they play it on K Street. Lester Munson at BGR Group. Of course, our good friend here, often a panelist, and great to have a long-form conversation with Lester. We'll have much more ahead on Balance of Power. This is Bloomberg. we get ever closer to our Fed decision here, special coverage starts a little more than an hour from right now on Bloomberg Radio, on the satellite, and on YouTube, where you can find us as we speak. Go to YouTube, search Bloomberg Global News. Our live stream is flying, and we would love to have you join us always, however you find us here on Bloomberg. We make it pretty easy, and we'll be inviting our global television audience in the next hour as we gear up for the decision on interest rates and, of course, the news conference that's going to follow. What Lindsay Owens would ask if she were in that news conference today with the chair, Jay Powell, or maybe what she would say, "I told you so?" She's not like that, though. Groundwork Collaborative Executive Director, former Senior Economic Policy Advisor to Senator Elizabeth Warren. Didn't that cross your mind? Great to see you, Lindsay. At 8:30 this morning, you said, "I told you so." You should have started cutting by now.
Oh no, not quite that spicy or vindictive. I mean, I just think for me, when I saw the numbers this morning, breathed a huge sigh of relief. 0% year-over-year inflation. It's hard to get much better than that. And the second thought that came into my mind was, you better cut in September. I mean, there is no reason to be looking past September to November now.
Okay, I got you. Are we going to hear that today, or are you concerned that higher for longer remains the message this summer?
Yeah, I mean, I am really concerned that that this may slip to November. I think, Powell has been pretty hawkish on this front, but I think the data really supports a September cut for a couple of reasons. But the primary one is we are now, if you exclude owner's equivalent of rent, we are now actually on the year below the Fed's 2% target. So the last mile here is housing. This is a housing story. We've talked about this before. And again, the interest rate environment does not do you any favors on the housing front, and if anything, could be exacerbating some of the housing price issues that we're seeing lingering in the inflation numbers. So the rest of the data suggests that we have got to see cuts, and the housing story doesn't get better with this punitively high interest rate environment.
Whether we're talking housing or just broadly, Lindsay, at what point do high interest rates become inflationary on their own?
I mean, I think we're pretty much there, right? We've got folks locked out of the mortgage market because the cost of borrowing is prohibitively high. We're starting to see an increase in credit card delinquencies for some borrowers. That's not a great situation to be in economically. We're starting to see a little bit of signs of a slowing labor market. I mean, we're still obviously just in an incredibly strong labor market. We've had now more than 2 full years of unemployment at or below 4%. We're seeing folks who've been on the sidelines in the labor market, who've wanted to get pulled into the labor market, able to get jobs. Americans with disabilities are able to get jobs at higher rates than in decades past. So, we've got a really strong economy here, but I do think the Fed has got to stick to its promise to follow the data. And the data is saying, look, we're below the Fed's 2% target when you pull out owner's equivalent of rent. The other thing we're seeing on the housing front here is, new leases are coming in low. So this is really kind of a hangover of older leases. And that's not a problem you solve with high interest rates, right? People have just got to, flow through those older leases. They come back online and you get those at lower price points. So I'm definitely ready for interest rate cuts. I'll tell you, I find it quite concerning that you hear over and over again in Washington that the Federal Reserve Chair will be uncomfortable cutting interest rates in September because it's so close to the election.
Yes, right.
And, I actually view that position. I understand that folks think he's trying sort of not to be political by not cutting interest rates before the election. I view that as dangerously political ground. If the data supports a cut in September, there should be a cut in September, right? He shouldn't sort of be playing timing games with the election here. Manage the economy like you said you would, adhering to the data, and go for the cut in September.
It's really something, too, when you read the president's statement on this today. It begins by saying, not, hey, look, everyone, this is great news. It begins by saying prices are still too high. And he has to keep saying that I suspect, publicly. We're going to talk to Wendy Benjaminson about that in just a second, Lindsay. The fact is, he's got to be thinking, look how far we've come, right?
I mean, absolutely. We're now almost 2 years of inflation falling off its June 2022 peak, right? So we've come a huge way here. But Americans are upset about high prices, and they're also upset about how pricing works. And the administration has been taking this on aggressively. The junk fees that Americans are paying, the drip pricing, the personalized pricing, you paying more than your neighbor for the same sweater because of the user interface dark pattern you got pushed into through your Instagram app. I think, it's not just the high prices Americans are upset about, it's how pricing works. And I think, what he said in his statement is he's also taking that on. He's taking on the drug companies who are jacking up the price of insulin. He's taking on the hotels who are adding all manner of, fees and other sort of deceptive add-ons to your total bill at the end of your stay. And I think that stuff is really resonating with the public because they're sick of that crap. And so that's also what he said in his statement today, is that he's doubling down on those efforts.
There you have it from Lindsay Owens. It's good to have you back on a Fed Day, no less. Groundwork Collaborative Executive Director. Thank you, Lindsay, for the insights. As we bring in the aforementioned Wendy Benjaminson, who had her eyes on this statement as well when the White House decided to speak up this morning. She is Bloomberg's Washington senior editor. Nice to see you.
Nice to see you.
I don't care if you're running our poll or if we're talking about Joe Biden's message of the day, which frequently veers into different things, including the border, including reproductive rights. But this is the stuff that he needs to be talking about every day. I'm just curious your thoughts on the reaction here, because he could take a victory lap, right? Look at the markets and maybe do what Donald Trump might do.
And he has for months.
But prices are still too high. He has to say that.
He has to say that, but I think this is the first time he's done that. I mean, been watching, maybe I missed a month or so, but I've been watching his statements over the whole period of this, where he does nothing but spike the football. And while he has good reason to spike the football, the rate of inflation has slowly been coming down. Prices in the grocery store, prices at the gas pump have not significantly changed, and voters are feeling that. So you tell an average voter that the rate of inflation has slowed, but prices are still 3% higher than they were yesterday and last year, and you got a 1.5% raise, that's not going to do it. So in November. So the fact that this month they decided to start with that simple sentence, prices are still too high, is an acknowledgement of the pain that voters are still feeling when they go to buy things.
Do they believe him when he says that, he's going after big pharma? Republicans allow the special interests from big oil. They're fighting for billionaires on Park Avenue. I'm fighting for families. Is that resonating after 3 years of this?
Maybe. The polls are not really showing that. I mean,
because people are remembering Donald Trump's economy as a lot better than this.
Right. Now, of course,
whether that's real or not.
Right. That was before a global pandemic.
Sure.
And that was before a huge infusion of federal spending. But the economy, there's no argument that the economy is getting better. And it is. And Biden, should politically take credit for that. Voters still aren't feeling it. And he's talking, though, about how I presume he means in a second term, he will actually get some of these things done that he's been talking about for 3 years, working with pharma, bringing taxes down, things like that.
Well, we're going to have a grand debate about extending the Donald Trump tax cuts next year.
Yes. Well, if Trump wins, we are, yes. Oh, well,
that's
yes,
true.
You're
Although
right,
they're starting the full court press with his visit this week. We're going to talk to Kevin Brady about that a little bit later on. You wonder, to the extent that deficits are going to matter in an election year. It's funny how people get amnesia over deficits. Is Donald Trump running the agenda here in Washington for Republicans with or without this election? Because it's feeling like it with this meeting tomorrow.
Absolutely. There's no question that Donald Trump is the head of the Republican Party, is the driver of Republican Party policies. And this meeting on Capitol Hill, to which even Mitch McConnell, who has never had a lot of love lost for Donald Trump, is attending. He is meeting with the House Republicans and Senate Republicans to set the policy for the rest of this year, and then if they win after that. I think even if he loses, loses, and Biden is president, Republicans in Congress will still be pushed and pulled by Donald Trump in terms of the policy that they're going to talk about tomorrow, right before he goes and meets with the most powerful CEOs in the country down on the wharf tomorrow afternoon.
Speaker would love to deliver a contempt vote for the Attorney General Merrick Garland to give to the president when he comes to town. Are they going to make that happen today?
I think they're going to try. The odds are not firmly in their favor that they're going to succeed. There are some centrist House Republicans, some House Republicans who used to work for the Justice Department or the FBI who feel that this is not right to do. And right after the conviction of the president's son on gun charges, what are we? I mean, they're
this
holding
is over
him
the release of audio recordings of the president. By the way, is it funny?
But it's also
You're an
about
editor.
the weaponization of the Justice Department.
It is,
They're
yes.
feeling that that's what's
Well,
happening.
and the Attorney General doesn't think that due to privacy issues and many other things, but the precedent that would be set, you get the transcript, not the recording.
Right.
Is it funny that we still call them tapes? Half the people listening never had a tape, but they know
That's
what we
right.
mean by audio tapes. I just
Right.
think it's funny. There are
It
no
is
tapes.
funny. That's
They're like
right.
MP3s or something. That's going to be a big story tomorrow.
Yes.
And it's going to set us off in a conversation, whether there's a contempt vote or not, about Donald Trump's economic policies. And I hope that you'll be back with us to do it again soon. I know are you in the field right now for our next poll?
Not
Are you allowed
yet.
to say that?
After the debate.
Okay.
We'll go on the field right after the
inside
debate.
information
Yeah,
right
there you go.
Wendy Benjaminson, Bloomberg Washington senior editor. Always great to have Wendy's insights with us. As we prepare to assemble our panel, we'll have primary results with an eye on Nevada and South Carolina coming up next. Was that a good night for Kevin McCarthy? Doesn't seem like it. This is Bloomberg.
equity on Wall Street. We do check markets all day long here at Bloomberg. 1 hour, 20 minutes to go until the latest Fed decision, 2 o'clock Wall Street time. Complete coverage on Bloomberg Radio. Our coverage, by the way, will kick off at just about 1:30 Wall Street time. The Dow, the S&P, NASDAQ are all advancing. We're looking at records on this Fed Wednesday right now. What will happen at Jay Powell's news conference? We have got the S&P up 57 now, 54.32, a gain there of 1.1%. NASDAQ up 294, up 1.7%. The Dow's up 0.1%, higher now by 37 points on the Dow Jones Industrial Average. But again, the S&P trading above 5,400, 54.32. Stocks hitting records as a broad cool down in inflation spurs a plunge in bond yields. 10-year, 4.23%. The 2-year, 4.67%. Spot gold up $19 the ounce now, higher by 0.8%, 23.36. While West Texas Intermediate crude oil is up 0.9%, 78.59 for a barrel of WTI. Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets. She says she will be listening closely to Jay Powell's news conference.
If I look back to that last Fed meeting, I think one thing that really concerned me was that after we got out of the press conference, we really saw people latch onto a very dovish narrative and take it too far in one direction, and then we had to dial that back down, and that generated some volatility in equity markets.
Lori Calvasina of RBC Capital Markets. Again, stocks higher. Apple at a record, advancing 4% right now. Oracle, after earnings, also surging to a record. Oracle up now by 12%. Broadcom reports after the bell today. Again, recapping, stocks higher. S&P at a record, up 57, up 1.1%, 54.32 right now on the S&P 500 index. Balance of Power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you. And thanks for being with us on the fastest show in politics here on Bloomberg Radio, on the satellite, and on YouTube. We are live from Washington, where, the Fed is preparing its statement. We'll bring you special coverage starting 1:30 p.m. Washington time, as you would expect, here on Bloomberg TV and radio, with the decision, with the news conference. As we pick through results today from primary night last night in some pretty interesting states. And I'm going to start in South Carolina, where the question is, did Nancy Mace win or did Kevin McCarthy lose? I know it's easy to say both, but this is interesting. Nancy Mace, Republican from South Carolina, friend of Donald Trump, was one of the 8 Republicans to vote to oust Kevin McCarthy when he was Speaker. And so he turned his fire and money on her in a primary. And boy, she didn't have too much trouble easily defeating Catherine Templeton to get to the general. No runoff is coming in South Carolina. And so there are some questions about the power of incumbency versus the power of the former speaker, who's got a lot of money left in his pocket. And so let's assemble the panel for their take. It's not just South Carolina. We're going to look at Nevada as well, with some interesting findings to pick through. Rick Davis and Jeannie Shanzano are with us, Bloomberg Politics contributors. Our signature panel in place this morning after. And Rick, as the Republican, I'll start with you. I'm curious your thoughts on the McCarthy effect and his potential to change outcomes as he puts his money to work in this campaign. What happened in South Carolina?
Well, as you said, he's going after the crazy eights, those guys who voted to kick him out of the speakership. And Nancy Mace was the first one on the list. And she handily won over 50%. That meant she didn't have to go into a runoff. And that was after McCarthy tried desperately to beat her. He spent over $2 million of PAC money against her on TV, spent hundreds of thousands of dollars for her opponent. He was all in. That being said, Nancy Mace is a survivor. We have to remember 2 years ago, Donald Trump tried to beat her. And so she turned away his effort to throw her out of Congress, just like she's turned away Kevin McCarthy's. And I think at this point, we're running out of enemies. It'd be interesting to see what happens in 2 years for her. But I'd say she gets the Survivor Award for the last 5 years.
Survivor Award. Did it help that she warmed up to Donald Trump in that time, Jeannie?
absolutely. Let's face it, Donald Trump had a good night last night. And, you know, his endorsement was very helpful to her. So I sort of think that Donald Trump won the night, if you will. But there's also the reality. It is really, really tough to beat an incumbent. You know, we keep talking about how vulnerable incumbents are in the modern presidency, but in the modern Congress, they, you know, to get one out of office is really, really tough. And so, you know, she is an incumbent. I think in this election cycle, and I'll have to check this data, but I think there has been only one incumbent so far who has lost in a primary. I think, Rick, that's in Rick's state of Alabama, but it was an incumbent on incumbent race because of redistricting. I don't know of any others, but the bottom line is a very small number of incumbents have lost. And so that's also part of the story. So you couple Trump with an incumbent, that's a hard match to beat. And of course, Nancy Mace, she deserves credit. She pulled it through again.
That's for sure. Rick, take us to Nevada, where we had a really important primary here, Republican primary, to find out who's going to run against Senator Jackie Rosen, who many say is the most vulnerable Democrat in the Senate. A big one for, interesting to say this at once, the establishment and Donald Trump, as we've discussed. The former president came around on Republican Sam Brown, who was also backed by the NRSC. He had the establishment behind him, the mainstream candidate. It was a very late endorsement, though. Sam Brown blew the doors off. He won by 40 points or something here, Rick. Did Donald Trump just finally sense how big that win would be and put his chips in the right place?
Yeah, I think Donald Trump has been pretty disciplined this year. He has been supporting a lot of the mainstream candidates. I'd say Nancy Mace certainly is a good example of that. He could have, you know, supported a challenger like he did 2 years ago, but she's fallen into line. Most of these others have. And Sam Brown, you know, he's a guy who's going to be seen as a Trump pick. That being said, he's a pretty good candidate. He did really well, as you point out. But this is the really biggest incumbent race, I think, in the Senate for the Democrats. They really need Jackie Rosen to win. She didn't really have any opposition in her primary, and she stockpiled a lot of cash. She's got like $10 million cash on hand compared to just $2.5 million for Sam Brown. But this is such an important race. I don't think money's going to make the difference because every outside group in America is going to show up in Nevada spending heavily to win this seat.
Well, and there are questions about the top of the ticket there, Jeannie. This is one of the states we look very closely at. Donald Trump was just there, as I mentioned last weekend. He's offering culinary workers, hospitality workers in Nevada to make their tips tax-free. What does Joe Biden do to answer this in an effort to help Jackie Rosen?
Well, you know, I'm not sure him going out there is going to be much of a help to Jackie Rosen. I think she's going to be doing this pretty much on her own in spite of the top of the ticket. It's going to be a really, really close and tough race for her. She does have a lot of money. They are well organized, but she is not, you know, she doesn't really have the name recognition that Cortez Masto had, and that gave an advantage in 22. She is a good candidate, but I think this, you know, this is one where you don't have to look far to see that this is one that Democrats are desperate to hang on to and going to be one of the toughest for them to hold this year. And certainly a lot of more money is going to pour in there now that Republicans have, you know, settled on who's going to be her opponent. And he is going to be a tough opponent. He's better than he was when he ran in the primary last time, for sure.
Mm-hmm. What does that say, Jeannie, about the most union-friendly president in American history? I thought if you won the culinary union on the Las Vegas Strip, you won the state. And now we're hearing about Donald Trump again in this case. Is this not a statement on organized labor?
It is. It's, you know, we used to talk about like a tale of two cities, a tale of two states in some places. This is like a tale of two organizations, because at the top, you do see that continued old style support of a Democratic president who has done a lot for labor and has fancied himself the most labor-friendly president. And yet, and the base, and you look at the numbers there, they are likely to go for Donald Trump. And, you know, the reality is Donald Trump has fought hard as well for that base. I mean, he has really put himself out there to make that case. So he is not going to just let Joe Biden run away with it because he gets union endorsements. He's still fighting this out. So that's what's making this so tough. Not to mention, we're once again seeing in the Sun Belt, Donald Trump is doing better and Joe Biden is doing better in the Rust Belt. And of course, in this case, the union in the Sun Belt states are, you know, a problem for Joe Biden at the base level.
Well, this is really interesting because tomorrow Donald Trump is coming to Washington. He's not only going to be visiting with politicians, and he's got meetings in the House and the Senate. He's even going to apparently be in the same room as Mitch McConnell for the first time since 2020. That ought to be something. But he's going to be sitting down with the Business Roundtable, right? This is corporate America, 90 top CEOs in the same room. Apparently going to be interviewed by Larry Kudlow, so a friendly Rick. Donald Trump's message on business here. We're talking about the influence of the economy. We started this hour talking about CPI today. We're going to be going into Fed coverage coming out of our conversation next hour. How important is it for Donald Trump to convince that room for him to be a viable contender or to keep, in some cases, his lead over Joe Biden?
Yeah, I'm not sure how election impact this speech will be, but it will certainly have a way of opening up doors to money. And we, of course, have seen Donald Trump really working hard to get some cash in the bank because his campaign has been behind on its fundraising activities. And so whether small dollar donors coming in after the convictions or really large dollar Wall Streeters coming in, this is really going to be the primary focus. But it's going to be on issues, and he's going to talk about, you know, making those Trump, 2017 tax cuts permanent. He's going to want to talk about reduction in regulations. To be honest, this is the sleeper issue, I think, of this election, because Joe Biden has not seen a regulation he didn't like, and his cost of regulations over $1 trillion taxes to corporations, and Donald Trump actually reduced the amount of money that regulations have to commit to be able to maintain regulations during his presidency. So it is a stark contrast, and I think felt by corporate America, and probably will resound very well in his comments to the Business Roundtable.
Well, Jeannie, after President Trump appears, or I don't know what order they're going to go in, White House Chief of Staff Jeff Zients is going to be speaking to the group here on behalf of Joe Biden, who, of course, is on his way to the G7. Apparently, he'll be in a conversation moderated by one of the CEOs, not a former staffer in the case of Donald Trump. Is there any point in even going? What's he going to say?
You know, I think, first of all, the statement the Biden campaign, or the White House, not the campaign, released today on the inflation numbers is the best one I've seen so far from them. And I think they're starting to finally, maybe a little late for some of us, coalesce around a message, which is to stop trying to convince people that what they've done is good and they should be given credit for it, but to meet people where they are, which is prices are too high. And then to say, who are we going to be here for? And that is the middle class. And who are we blaming for prices, and who are we taking on? Big oil of the kind that Donald Trump was down there saying, give me $1 billion. I'll get rid of all these, regulations and all these environmental steps that Joe Biden has taken. So I don't know how far Zients will go in the roundtable making this case, but that is the case that the Biden team needs to keep making. They are finally starting to see that they can't talk people into liking how the economy is, but they can meet them where they are and say they know how to move forward, and that pin Donald Trump down as a friend of billionaires, CEOs, Wall Street. So I think Trump's visit there tomorrow is one the Biden team, at least the campaign, will want to highlight and say, look, this is who he is going to see. And thankfully, Joe Biden is out of town doing the work of the president, so he's not going to be attending.
Rick, I don't want to set you up. We've got less than a minute here, but does anyone in that room care about deficits? Will that be part of the conversation tomorrow?
Yeah, I think that it's a growing concern. I think that as we come out of all these impacts of things like COVID and there's some stabilization of spending, that there's an expectation by groups like the Business Roundtable to start cutting back on the rate of growth of the deficit. I think they see never-ending deficits as a potential problem for the country long term.
Well, we're going to talk a lot more about this with our panel in our second hour, because this visit will reignite the debate over making the Trump tax cuts permanent. And we have a special guest with us in studio next hour. Former Congressman Kevin Brady of Texas, used to chair the Ways and Means Committee, will be sitting down with us coming up next. Stay right here on Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
next comes the fight over taxes. Welcome to the fastest show in politics. As Washington prepares for the return of Donald Trump, a visit tomorrow, and the grand debate over potentially making the Trump tax cuts permanent. I'm Joe Matthew alongside Kaylee Lines in Washington. Welcome on Bloomberg TV and radio. We're just a day ahead on this one, Kaylee. It's going to be a big debate that starts tomorrow.
Yep, a meeting with first House Republicans, then Senate Republicans, and then a meeting with the business leaders, essentially, here in Washington. So he's going to be making a full court press, if you will, here in Washington to talk about things, including his tax agenda. But that's all tomorrow. We also have to talk about the news of today, which was cool CPI, Joe, ahead of the Fed, which is just an hour from now.
Yeah, pretty remarkable. Our special coverage starts in 30 minutes here on this Fed Day, CPI Day as well, and that means a busy one for the markets, Kaylee.
Indeed. So let's get a check on those now. Charlie Pellet has a look at that from New York. Hey, Charlie.
Hey, thank you very much, Joe and Kaylee. One word for you. Record. Dow, S&P, NASDAQ, all advancing right now. Records certainly for the S&P and the NASDAQ Composite Index. 1 hour to go, just under an hour to go until the big event, the Fed decision. 90 minutes from now, the bigger event, Jay Powell's news conference. Yes, we got you covered on Bloomberg Radio and television. Stocks climbing to records as that broad cool down in inflation spurs a plunge in bond yields. 10-year, 4.25%, 2-year, 4.67%. Equity markets ripping higher across the board. S&P up 59 now, up 1.1%. The Dow up 48, up 0.1%. Tech stocks, the big story. NASDAQ up by 308 points now, up 1.8%. NASDAQ 100 index up by 1.4%. The Russell 2000 index of small cap shares, the outperformer by far, surging now by 2.6%. Spot gold up 0.9%, 23.37 the ounce. West Texas Intermediate crude up 1%, 78.69 for a barrel of WTI. Apple surging to a record today, up another 4.1%. Also at a record, Oracle shares up now by 12.2% after last night's earnings report. So lots going on. Recapping, stocks higher, S&P up 71, up 1.1%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet with a pre-Fed decision check on the markets on this CPI day. Pretty remarkable to see stocks at a record. But of course, Joe, interest rates are still high and they will likely stay high after the decision today. And often we talk about here in Washington the political implications of that. But there also is a fiscal question around the very high level of borrowing costs and an incredibly high level of debt. And as we get ready to see former President Donald Trump meeting with congressional Republicans tomorrow, addressing the debt, also addressing just the ledger, how much money's coming in versus how much money is going out, definitely going to be on the agenda.
Yeah, that's right. And of course, there's going to be a big drive for Donald Trump supporters to reinstate or make permanent, is a better way to put it, the 2017 Trump tax cuts. They are set to expire next year, Kaylee, and this is a big push in Washington. We're already hearing a lot about this, and it's at a time that frequently the concept of debt and deficits can be forgotten in a campaign season. But it's obviously an issue that Washington needs to get its arms around pretty quickly.
Especially when you consider the potential impact that that could have. I actually spoke about this last month with Philip Swagel, who's the director of the Congressional Budget Office, and he talked about how much it would cost realistically to keep those tax cuts intact in 2025.
That's right. That important parts of the 2017 Tax Act expire at the end of next year, at the end of 2025. Those are not in our fiscal projections in the sense of, the taxes revert to the pre-December 2017 law and there's more revenue. So extending the parts of the Tax Act that expire would cost upwards of $3 trillion over 10 years and really closer to $4 trillion, including the interest service.
$3 to $4 trillion. We're talking big money here. And it's going to prompt a conversation about spending as well as taxation while we're at it, Kaylee. And that's where Kevin Brady comes in. With us at the table today, you know him as Congressman. We call him former Congressman now, former chairman of the House Ways and Means Committee. Kevin Brady is now spokesman for the Alliance for Competitive Taxation. And we're lucky to have him just in time for the annual congressional baseball game. It's great to see you. Welcome back to Bloomberg TV and Radio. What a treat to have you at the table here. This is going to be part of your cause. So what do you have as a response when you hear about debt and deficits as an answer to making these tax cuts?
Yeah, so one, you have to ask the question, what happens if they don't extend it? So, putting a $3 to $4 trillion tax hikes on families, Main Street businesses, on American competitiveness has real consequences for lower paychecks, much slower growth in the economy, U.S. less competitive at a time China's super aggressive. You know what I mean? They want to dominate our industries and technologies. And so I think it's going to be crucial for both parties to find a way forward to extend those tax cuts, especially for those families, Main Street businesses, and our competitiveness. You may remember the reason we did it was that for a decade before 2017, the economy was slow growth, less than 2% for a decade. Paychecks have been flat, and every other month we saw another U.S. company move overseas. So we had to modernize the code in a big way, lower rates, but we did it in such a way we created code built for growth of jobs and the economy and paycheck. We wanted to make sure we were the desirable location for new plants, innovation. We did that. We wanted one of the most competitive economies on the planet. We did that. And as a result, paychecks, the thing I think I'm proudest of, in the first 3 years after tax reform, paychecks, inflation adjusted, went up 9%, the highest level since we began keeping records. So people were getting ahead in a big way. That's really the legacy of those cuts and why Congress has to find a way to extend those or make them permanent.
But people were getting ahead. At the same time, the deficit was growing. So if you, as you say, businesses and consumers actually need these to stay in place, how do you make it fiscally responsible?
Yeah, so the good news is there's ways, and here's why. People remember the tax cuts is costing $1.5 trillion, even though we've seen record revenue. Like corporate revenue today is higher at 21% than it was at 35% because of the growth. So we've seen good growth. But bottom line is the actual cuts were $5.5 trillion. We paid for $4 trillion of it. Reforms to lower the rates, to modernize the code, and to grow the economy in a big way. So lawmakers, as they extend the tax cuts, will also extend the reforms that help pay for it. That won't cover all of it. It's a good, solid step. So depending on the party, depending on, in an era where deficit and debts really matter, both parties are going to have to decide, so do we pay for all of it? Do we pay for most of it? What does that good policy look there? And so they're going to have to be looking at similar type reforms as we did in 2017 going forward for that very reason, to make sure we're not adding, significant amounts to the debt.
But you're sitting down there in Texas looking up at this crowd now. We can hardly figure out a budget to pay for the government, never mind deal with a debt ceiling that's going to be looming. Do you trust the people who currently serve in Congress to do what you just said, extend the tax cuts and find a way to pay for it?
I do, and here's why. I think there's a middle class in Congress, people you don't see or hear about often. They are very solid, trying to do the right thing, serious lawmakers, and they're going to be the ones to be putting these packages together.
Are they on both sides of the aisle?
So I believe there is. And I think that they can, because sort of like 2012 when we saw the Bush tax cuts expire, both parties had a lot at stake, in that. And they do again in 2025. But the thing is, my point is, don't just extend or make permanent, keep improving the tax code. We can be more pro-growth. It can be simpler, especially on small businesses. Things have changed, because of China is so super competitive. AI has changed things. Innovation should be, especially for our U.S. companies, the country that wins the innovation race wins the future. And ACT's top priorities are keep America competitive, make us the most desirable place for those new plants to innovation, keep incentivizing innovation in the U.S. And I think those are policies both parties, I think, can embrace.
Well, it's going to be one party, or at least the majority of the parties in both chambers meeting with Donald Trump when he's here in Washington tomorrow. To what extent is he already influential on this conversation, knowing that there was a bipartisan tax bill that passed the House with massive bipartisan majority that ended up going nowhere in the Senate? And some people were telling us it's because it's an election year. And if you expand the child tax credit, potentially Biden gets credit for it. It becomes political. I wonder what you think of that narrative.
Yeah, so I think, President Trump's very influential, certainly among the Republican Party. These drove his economic agenda that is so popular with the American people. So he's got a big stake in extending that. And the corporate rate cut, for example, that drove so much of the paycheck wage growth was his signature achievement. So he's going to play a big role. I think some of the dynamics of this year's tax bill will still be front and center in 2025. You know, you're going to have businesses, you know, Republicans that want the middle class cuts, the small business cuts remain in place, and want America to be super competitive. Democrats are going to want a child tax credit that looks like the COVID era credit. They're going to want to defend the green energy subsidies, Inflation Reduction Act. So you can already see sort of the battle lines being drawn. But 2025, with the prospect of $3 or $4 trillion of tax hikes, it's going to focus leaders in both those parties, tax writers, who are already beginning their work.
We're still waiting for the tax code to fit on a postcard. Wasn't that going to happen?
You know, I tell you what, in the House, we did exactly that. Our version was 13 lines on a postcard that 90% of Americans would use to file. I still dream about that. Because,
I'm sure there are many others.
Can you imagine you and I looking at a postcard and saying, this is how I'm taxed, and more importantly, that's how my neighbor is taxed. There's real power to simplicity. So I'm, you know, if you ask me things I dream about, I wish we could have actually achieved, you know, the postcard, and that fairness from that is certainly one of them.
On the subject of what could be dream and what could be achievable, we had Donald Trump over this past weekend in Nevada floating no taxes on tipped income.
Yeah.
Do you think that is actually something workable, knowing he would need congressional approval to actually do that in a second administration? Or do you think that was just kind of an idea that was thrown out there, given the audience?
No, I think it doesn't surprise me. And here's why. Because during tax reform especially, you couldn't be at the White House that he wasn't asking, what are we doing for the little guys? What are we doing for the blue-collar workers? I mean, that is part of who he is. I don't know tons about the tip thing, but here's... So full disclosure, I'm one of those people. I want fewer tax provisions for some, lower rates for everyone. I think that's the fairness here. But I think there's two impacts. One, if you tax less of something, you get more of it. So I think there'll be more wages sort of redesigned on the tip model. Secondly, those are industries that really have trouble hiring people and keeping them. You know what I mean? Those service industries. So you may see more young people. I was a waiter and a bartender. I've lived that tip life as well. And so you may see more people drawn to some of those service industries that traditionally, you know, it's been hard to cover those tables. That's for sure.
Yeah. All right. Well, sir, great to have you here in our studio. Thank you so much for joining us, Kevin Brady.
At the ballpark.
Yeah, good day. It's going to be great.
Indeed. Beautiful night here in Washington. Former chair of the House Ways and Means Committee, now spokesman for the Alliance for Competitive Taxation. We appreciate you joining us. We want to turn now to our political panel as we look ahead to the perhaps non-tax related discussions that will be happening on Capitol Hill tomorrow between former President Trump and congressional Republicans. Rick Davis and Jeannie Shanzano, our signature political panel contributors here at Bloomberg, are joining us now. So, Rick, do you think that there's actual items on the agenda for these meetings, or is most of this about optics and the show?
Yeah, well, first of all, you can't get away from the optics in the show, right? We're right in the middle of a presidential contest, and I think that part of what Donald Trump's message is going to be is, hey, our boat floats with me at the top of the ticket. Anybody who thinks that they can do better is crazy. Everybody needs to rally around my candidacy. It's going to be all about how the top of the ticket is going to drive the outcome of the election, and that's the political message. I think that when you get into substance, I think that Donald Trump's going to make sure nobody goes out there with an agenda that somehow puts either his campaign in a bad light or the Biden administration in a good light. Certainly the untold message, you won't say this specifically, I would assume, but you never know with Donald Trump, is that don't do anything that's going to cause me any problems between now and November. That is probably the most important thing, because there are various elements of the House and the Senate who have agenda items that could cross-pressure his campaign, and he doesn't want any of that stuff happening. So it's almost like, play along with my campaign, do what I tell you to do. We're all unified around me, and don't do anything between now and November that's going to cause a problem for my campaign.
Jeannie, you just heard the pitch from none other than Kevin Brady, who used to chair the House Ways and Means Committee. with a strong argument on making the Trump-era tax cuts, as we call them, permanent. This is going to be a big debate that makes its way onto the campaign trail. What's Joe Biden's answer?
Well, first of all, I love the 13 lines. I remember a good postcard, and I love that. So I wish Kevin Brady would come back and fulfill that. I think what is going to happen, or what should happen in a serious discussion, is to look back and look at the reality of Donald Trump's record. You know, he promised cuts and he delivered those cuts for billionaires, for the very wealthy, and for big corporations. He reduces the corporate income tax to 21%. He's the first president since Herbert Hoover to leave with less jobs than when he came in. And of course, he had the pandemic to deal with. So I will cut him some slack on that. And the budget deficit has soared under both him and Joe Biden. And we're now over $3 trillion. So, you know, I think he likes to hype his record, but I think real serious questions have to be asked about both his record in the past and what he wants to do now. If he wants to grow our military, for instance, how is he going to do that if he is cutting revenue? You know, in a way, this isn't complicated, right? If you're going to spend more, you got to tell us what you're going to cut. I don't suspect we hear any of that tomorrow, by the way, but I think those are the serious discussions that have to be had. And I think on Joe Biden's part, he's got to say, we haven't reached where we should. We still have very high costs in this country, but we are moving in the right direction. And I am going to take on all of those corporate billionaires and the corporations that Donald Trump has been delivering for and continues to promise to deliver for if they give $1 billion to his campaign.
Well, Rick, to Jeannie's point on if you are going to reduce revenue, you also need to reduce spending. We all know how big the slice of the pie is that you can actually reduce, because the mandatory part of the ledger is just so much larger than everything else. There's very little discretionary that you can actually cut. The problem is when all of that, or a big chunk of that, is entitlements, neither Joe Biden or Donald Trump can touch that politically, right?
Well, certainly they're not going to touch it between now and Election Day. They've both been very clear about their lack of interest in reforming entitlements. The real question is, both of these guys, regardless of who wins, this will be the last job of their political career. And so they have an opportunity to then sit back and say, you know, in order to reform some of our fiscal house, we have got to start to get these entitlements under control. Because as you point out, Kayleigh, I mean, there is no such thing as cutting a budget without touching the entitlements. The rest of it is just optics. And so that's the question, is do they have the political wisdom and courage in the last 4 years of their political career to try and put the country on the right track when it comes to this excessive entitlement spending that's going to bankrupt the country at some point if it's continued to go unchecked?
Our great panel, Rick Davis and Jeannie Sheehan Zaino, our signature panel on balance of power. Many thanks to both of you for helping us distill all of this. We're going to be talking a lot more about it, of course, tomorrow when Donald Trump makes his visit here to Washington, D.C., meeting with lawmakers on the House and the Senate sides. And coming off of our CPI data this morning, Kayleigh, we're looking ahead to special coverage here a little bit later on this hour as we prepare to hear from the Federal Reserve. Two big shots today on the economy in Washington.
Yep, first inflation data, then a decision and a press conference from Chairman Powell. And we're going to talk to the White House about these things coming up. Heather Boucher of the Council of Economic Advisors will be joining us in just a few minutes right here on Bloomberg TV and radio.
7:21 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at records on this CPI Wednesday, a Fed Wednesday as well. S&P now at 54.37. Stock market pushing higher. S&P right now up 1.2%. We've got NASDAQ up 323 points, up by 1.9%. The Dow up 0.2%, up 66 points right now. Perhaps the big stock market story, the surge in the Russell 2000, up now by 2.6%. Bottom line here, stocks hitting records as a broad cool down in inflation spurs a plunge in bond yields. 10-year 4.26%, the 2-year 4.68%. Spot gold up $22 the ounce now, $23.39, up by almost 1%. West Texas Intermediate crude up 1%, $78.68 a barrel. Apple has overtaken Microsoft in market cap on an intraday basis. Apple shares at a record, up another 4.8%. After earnings, Oracle at a record, up 12.7%. And a deal in the energy industry to tell you about. Oil producer Matador Resources buying assets in the Permian Basin from a portfolio company of NCAP Investments for $1.9 billion in cash. Matador down now by just about 0.8%. Again, recapping, minutes away from our Fed coverage, S&P up 63, a gain there of 1.2%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet up in New York. Thank you so much. I am Kaylee Lyons alongside Joe Matthew here in Washington, where we're just as busy as New York is today with this double dip of big economic events. A Fed decision coming up in just over half an hour, Joe, after cooler inflation data this morning. On the headline monthly CPI figure, we get a 0.0%.
Yeah, kind of amazing. Markets love it. White House likes it, but treading carefully, as we see in the statement here. Prices are still too high, writes the statement from the White House, but today's report shows welcome progress on lowering inflation. Let's go to the source, and a great opportunity just moments before our special coverage begins here on today's Fed meeting to speak with Heather Boucher, a member of President Biden's Council of Economic Advisors. She's with us from a beautiful North Lawn today. And Heather, it's great to have you back. As I read the statement from the White House, which is clear, as I read at the outset, prices are still too high. I also wonder if you're thinking inside about how far we've come.
Oh, we have come so far in so many different ways. You know, I think about the economy that the president inherited and so many challenges, how we got unemployment down, how we got people back to work. And yes, prices went up, but we have seen prices come down by about 60%. And certainly good news today with the flat increase in prices overall. So this has certainly been giving, as the president likes to say, families a little bit more breathing room, and is good news for American families, and of course good news for American workers today, as we saw yet another month of wages outpacing inflation. That marks 15 months for the 80% of the workforce that are production and non-supervisory employees, where their wages have been outpacing inflation. So that's great news for workers and their families.
Well, Heather, even as we talk about a flat figure on the headline, there still is a bit more happening beneath the surface that shows some stickiness in certain areas, including shelter prices. Up 0.4%, owner's equivalent rent, similar. How can that realistically be addressed at this point when there are arguments being made, including by members of the Democratic Party like Senator Elizabeth Warren, that this is something that high interest rates are actually exacerbating because it costs more to borrow to buy a house? How can you be confident, as long as rates remain high, that the shelter price pressures are going to come down?
Well, let me give you two answers to that question. First, a technical one, and then a policy one. So first, you know, CA, the Council of Economic Advisors, we've been tracking this for quite some time. The way that shelter is accounted for, you know, you build in rents from leases that were signed a while ago. So you have a good sense when you look at real-time data how this might shift over time. You know, we have been estimating that these numbers will come down as the prices of new leases come down, and certainly that's what we've been seeing in general. Now, granted, we certainly want those to come down more, but that's taking up a larger share of the monthly increase in price changes. On the second point, though, in terms of policy, the president's been acutely aware of the challenges in housing. He has put together a comprehensive housing supply plan, and that would do a number of things. One thing that I just would like to point out is that that plan includes giving new home buyers a tax credit to make it just that much more affordable, which can help help ease the burden of those higher interest rates during these times so that people can get into those new homes.
Heather, at what point do higher interest rates in and themselves become inflationary, or are we already there?
Well, listen, we have been in this situation for quite a while now, and the expectations of where interest rates have been baked into, forecasts and where people are thinking about the economy. And certainly this is challenging for folks making those big purchases or things like that. But we remain optimistic that because of the success in the economy, and, critically, we have made so much progress, and that very quick progress in the beginning, but we have seen, things like the gains in jobs and output, that we're starting to see those get down to that kind of pace that is sustainable. And so that's what we're looking for. And, here today, we're here to talk about the fact that, we have these numbers on inflation that beat expectations on the low side. That certainly it's ongoing good news and means that we're going to get that extra bit of breathing room in the economy to continue.
Well, as we think about the strength of the economy that you're characterizing and, say, the labor market specifically, we have seen a lot more analysis of the way in which migrants have contributed to that. The idea that they are actually playing a very key role in the strong job growth figures we continue to see every single month. But President Biden just signed an executive order essentially cracking down on those seeking asylum. Heather, how quickly do you expect that might actually show up in the data? What economic impact could it have?
So the president does not expect this to have negative implications on the economy. Certainly we have seen that, immigrants are an important part of our labor market. They add to the economy. They go out there and get those jobs and in all the different ways then add to the economy as they're buying things. But we also know that the economy is very strong right now in terms of the labor market, and we've seen an unemployment rate at or below 4% for over 2.5 years now, and so that certainly is an indication of the strength that there are a sufficient number of jobs out there for anybody who wants to go out and try to find something. That continues to be a strong labor market, even though we've had this immigration.
We're spending time with Heather Boushey live from the White House as we prepare for our special Fed coverage here on Bloomberg TV and radio. There's a big debate about to begin, Heather. We were discussing it before you joined us about potentially making the Trump-era tax cuts permanent. There's a big drive among Republicans to make that happen. And as we consider the potential impact of greater deficits on inflation, I wonder what you would see happening to our economy if that took place. These are set to expire next year. What would happen if they were made permanent?
Well, listen, here's the thing. We know that the kinds of policies that the prior administration put forward were supposed to lead to a ramp up in investment and productivity and, particularly in manufacturing jobs across the country, and that's not what we saw. In fact, President Biden's agenda has led to that kind of sharp uptick in investment, and not doing it through the massive tax cuts that were, not good for the economy, but actually doing it through, smart, targeted policy that has led to real economic outcomes in communities all across the place. So as we're looking at this conversation about what should and should not expire, the president's been very clear. He continues to believe that no one making under $400,000 a year should see their taxes go up, but he also knows that we should not be just having giveaways for American businesses that are not tied to investment and growth and the kinds of things that really matter to our economy. So that, I think, is where the important real contrast is between that Tax Cuts and Jobs Act that only starved the government of the resources that it needed, and the president's proposals that have been put forward in a way that is helped to lower the deficit, but is also making those at the top pay their fair share.
All right, Heather Boushey, member of the White House Council of Economic Advisors, joining us from the North Lawn of the White House today. Thank you so much for being with us as we await less than half an hour from now the decision from the Federal Reserve, Joe. And of course, we are expecting that interest rates will stay where they are. The question is going to be, what happens in the dot plot? What signal do we get about how many rate cuts could come this year? And the question we all have here in Washington, could one of them come before the election on November 5th.
Yeah, that remains a big question. And of course, we'll be listening closely to Jay Powell in the news conference. All of that coming your way here on Bloomberg TV and radio. I'll point you to the late edition of Balance of Power. Kaylee and I will be back at 5 p.m. Washington time with a conversation with President Biden's chief economic advisor, Jared Bernstein. Kaylee, his take on what we saw at 8:30 this morning and are about to see in this Fed meeting.
Yep. Less than half an hour to go until the decision. Chairman Powell will take the podium shortly after that. So now we turn to a special edition of Bloomberg Surveillance with Tom, John, and Lisa.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Starts right now on TV and radio for our audience worldwide. Good afternoon, good afternoon. 27 minutes out from that Fed decision with equity markets at all-time highs on the S&P 500, breaking above 5,400 and positive on the session by 1 full percentage point. What a start to Super Bowl Wednesday. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. TK 8:30 Eastern Time. CPI coming out cooler than expected and igniting this equity market rally and taking the bond market with it.
I like what David Rosenberg said. You know, he said just simple as this, eureka. It's finally the first visible sign for disinflation, the disinflation crew, that now's the time, and you see it in the market reaction.
Yeah, Mike Ape and Bank of America agrees, Bramo. Expect more deceleration ahead. One giant leap for the Fed. More evidence the first quarter was an outlier. Q1 looks more and more like a head fake based on the inflation we've had so far.
One small step for the Fed, one large step for mankind at a time we're all looking for disinflation. When you look under the hood, this is the reason why people are getting excited about this. When you look under the hood, it was auto insurance cracking, it was shelter inflation that picked up, but a lot of people picked that apart and said that that was ready to go. Goods prices basically flat, airfares, recreation, personal services, all of the prices on those things, at least the pace of increases declined. Now the question is, let's see Act 2. What is Jay Powell going to say to actually move the markets any further other than just say, yeah, you see that? I mean, we can't declare victory, but yeah.
In about 25 minutes, you'll get a statement, some forecasts. 30 minutes after that, a news conference with Chairman Powell. Check out the price action. Let's start with equities on the S&P 500. We are positive, big time, across the board. On the S&P through 5,400 at 1 full percentage point. In the bond market, the 10-year down 14 basis points. The 2-year down by almost 15. Tom, for 6 consecutive Fed days, the 2-year has rallied, and it continues today.
It's extraordinary, and the thing that's important, the mathiness I did on the Bloomberg terminal before we started, was to see, are we still in range? And I would say we are, but on a 426 10-year, you look at Ian Lingen at BMO Capital Markets, we're about a third of the way to his nirvana. We made it in, 2-3 cups of coffee. It's really moving quickly, but we're still in range. Will Jerome Powell take us out of the range and finally break through?
Yields down, dollar weaker. Lisa, euro dollar 108.39.
And now up, we have Fed Chair Jay Powell. But before that, leading up to that press conference and the release of the decision, JP Morgan's Bob Michael will be with us, and Julia Coronado of Macro Policy Perspectives. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then we will get the decision, and we will get immediate reaction from Mohammed El-Arian of Queens College, Cambridge, KPMG's Diane Swank, and Bank of America's Michael Gapin. And finally, after the press conference, we will be breaking it all down with Kathy Jones of Charles Schwab and BlackRock's Jeff Rosenberg, and we'll be seeing if bond yields are trading around like penny stocks once again.
We can start slowly. Bob Michael of JP Morgan Asset Management with us around the table. Bob, good afternoon. It's good to see you.
Happy to be here.
What are you looking for now? It feels like the CPI report wasn't the appetizer for the main event. It feels like that was the main course this morning.
Yeah, I think there was a huge sigh of relief that came out of the Fed in Washington. I think Jay Powell is now holding all the chips. He can point to the labor market and say, hey, we're still at about 4% unemployment. That looks pretty good. We're meeting our full employment mandate. And look at inflation. It continues to come down. That glide path is intact.
Bob, I've got to ask, and I'll ask this of all of our guests today, because to me it's the hard question, particularly after Lagarde and the ECB. Are they still slaves to Greenspans measured, where once they move, they have to move and be measured and be responsible to maintain credibility? Or can they actually pull off a pre-ex post rate cut, given all the noise that's out there?
I don't think they're committed to, once they start cutting rates, they have to go in a disciplined path, either every meeting, every other meeting. I think what we learned in 2015, they cut once, and then it was another year, but well, they actually hiked, and then it was a year before they hiked again. So there's a lot of distance between Fed policy moves now. They've got a lot of tools at their disposal. We still have to remember there's the balance sheet that continues to run down.
Right.
Honestly, how excited are you for this afternoon? And I understand that you have to say you're very excited. This is going to be a tremendous decision and the most interesting news conference that we've ever seen. But, you know, kind of to the point that John was making, did the CPI report kind of take the wind out of the sails? I mean, is there anything that he can really say to move the needle other than, yeah, we're sticking with this and don't ignore us?
Well, admittedly, I'm not as excited as I was at 8:29 this morning. So for sure, when you look at the complete picture of things, it's exactly what you see in a soft landing. On some days, like last Friday, you look at the data, you can identify parts of it which looks like the economy's operating at too high a pace. And then when you look at today's data, you can look through it and find things that tell you actually things are slowing down pretty quickly. When you put it all together, this is what you get in a soft landing. And I think he's best to come in, deliver the statement, answer a few questions, and then get the heck out of there.
Well, let's see if he follows your recipe. As soon as we got CPI, I got a note from Neil Dutta of Renaissance Macro. They need to get on with it. And he said, you know, they're going to get behind. And basically nothing moves in this linear way. Would you agree that the best course of action would be to even open the door to a July rate cut?
Well, that's one of the things I do want to hear from him. I assume he's going to confirm that policy is sufficiently restrictive. I assume he's going to mention that the law of long and variable lags hasn't been repealed, and they have to be vigilant to that. Would I be surprised if they threw in a rate cut in July? Today, no. Do I think they're going to do it? I think there's less than a 1 in 3 chance they do it. I think they're very much on course for September. I think it wouldn't hurt them to see a couple months more data and then make the decision then.
So in 20 minutes, as you know, Bob, all we'll be talking about is the dot plot. And it's probably the first thing Mike McKee's going to really talk about with any detail. We're trying to figure out where that median dot for 2024 comes down to. At the moment, it implies 3 cuts for this year. Does it come down to 2? Maybe even 1. What are you and the team looking for when you get a statement of economic projections?
The dot plot will be great. 2 is pretty much the expectation. It's our expectation. If it's 1 cut this year, then it tells me they actually don't look at the data and then go back and revise their dots. That once they're submitted, that's it. And if it's 3, it tells me, well, actually, they do take a peek at the data, and then they have until 2 o'clock. Maybe they'll go in and revise some of their dots.
So you're saying that it should be 3, based on the data that we've gotten?
No, I'm saying that it should be 2. But if it's 3, it's because there's enough of the group in there that takes comfort from the slowdown. Probably they parsed through a lot of the labor market data, and they looked at the household versus establishment survey, and they're putting a little bit more weight on the household survey. So I can understand how you could have 3 dots, but I think we're going to get 2 rate cuts.
Pause, what you just said, do you think they'll put more weight on the household survey? Unemployment up to 4%. I just wonder what you think that means for their forecast, because right now they've got year-end unemployment of 4%. What's that coming up to in 20 minutes?
I think it will tick up to 4.1%. We spend a lot of time looking at the household survey. What jumps out at us is over the last year, the increase in unemployed is just over 500,000, and the increase in employed is around 300,000. So there's a weakness there that's not reflected in non-farm payrolls.
So 272,000 overstates the strength of the U.S. economy, your view?
Yes, I think it's one metric of the strength of the labor market. There are a lot of other metrics to look at. I think when you look at the quits rate, you look at a lot of the JOLT surveys, when you look at average hourly earnings and how those are coming down, there's a lot of things in there to tell you that there is some capacity being built into the labor market.
That would be quite a statement if Chairman Powell echoes that in the news conference a little bit later on this afternoon.
It would open the door to a July rate cut. That is what I think.
You think so?
Yeah. Well, at least it would raise the question of just how many rate cuts they could go for if they start to say, actually, we are seeing a deterioration in the labor market at the same time that inflation is coming in.
But he doesn't need to do that. He could say for the 30th consecutive month, we've got unemployment at 4% or lower. Inflation's not at our 2% target. It's coming down towards it. It's not there yet. There's no reason to do anything right now. I'm going to the beach for the summer. Let's check back in September.
You're doing that, or Chairman Powell is?
Maybe we both should do that.
Maybe we should all be doing that.
Will you join us?
I'm happy to come, Bob, so long as you're paying for the house. Bob Michael at JP Morgan Asset Management is sticking with us. That decision is 18 minutes away. That would be quite a statement if he puts more weight on that and says it explicitly in this news conference.
Well, that would give some dovish fuel to the rally that we've seen in bonds, which has been what we've seen, frankly, in the past 5 times he's spoken.
Amazing. Make it day 6 potentially. Yields are down by 14 basis points on a 2-year. Every time they meet, this 2-year just rallies. And it's happened again for a 6th consecutive meeting. Coming up very shortly, we'll catch up with Julia Coronado of Macro Policy Perspectives. Your equity market at all-time highs. This bond market absolutely ripping. Live from New York. Good afternoon.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The Fed's not going to move. They can hold off.
Higher rates are working to bring down inflation.
The policy is working.
It feels like immaculate disinflation.
It is immaculate disinflation.
They're going to try to sound neutral. They'll continue to say they're data dependent and that the data is murky.
Risks are skewed toward that one cut.
2 rate cuts. 1 or 2 times.
I don't think the market really cares whether we're going to get 1, 2, or 3 this year, as long as the next move is down.
The question is going to be September or December.
They're still going to be able to cut in September.
September.
Cut in December.
September and December. September or December.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
Each individual Fed commentary will be far less important than the sum of all of their parts. We're going to have to see what they say.
15 minutes away, we'll find out what they've got to say. That Fed decision just around the corner. Equities going into it, sitting at all-time highs on the S&P 500, on the Nasdaq. Quite a rally this morning and into the afternoon. On the S&P up by more than 1 full percentage point. On the Nasdaq up by 1.4. The Russell, the small caps up by 2.6. Thank you to the Treasury market. 2-year, 10-year, 30-year. Look at this for a rally. Yields aggressively lower. We're down by double digits across the board from the 2-year out to the 30-year. TK, the 2-year down 14 to 469.
Stay on this board. This is a really important board here on the 2-year yield to see it in 14 basis points. What's important here is everybody stews on this after the shock at 8:30 is the yield has moved further lower. John, it's out 3-4 decimal points, but nevertheless, there's a small oomph into this 2 o'clock decision here with the yield market betting lower yields, higher prices.
When this dropped at 8:30 Eastern time this morning, Lisa, we both said, let's see if it sticks. It's stuck all through the day.
This is the biggest decline in 10-year Treasury yields going back to December. We are looking at basically the biggest move since the pivot that Jay Powell put out there at the end of last year, which raises a question, is this sort of a new sort of acceptance of the Goldilocks soft landing scenario that you're seeing certainly play out in the Russell 2000? How can Jay Powell add to that? Or does he just basically do exactly what Bob Michael just auditioned for, saying basically, it looks good, yep, we're on track, we're still wary of risks, and thank you, goodbye, I'm done.
Do you remember last time the Fed met and I said it's whatever time it is in Tokyo, and they're very happy over at the BOJ and the Ministry of Finance? I can tell you over in France, they need to thank the CPI report in the United States because that triggered a move in the French bond market as well. Yields across the curve, lower in France, and a euro positive as well after being negative for the last couple of sessions. Just check out euro dollar. Dollar weakness today against the euro. Lisa, 108.39.
It kind of makes all of these efforts, especially by Emmanuel Macron, the press conference, all the rhetoric, the politicians, how much does that basically undermine all of that and the influence when in one session a CPI print can just completely undo it?
Joining us to discuss is Julia Coronado of Macro Policy Perspectives. Julia, that decision 13 minutes away. What are you focused on in the projections we'll get from the FOMC a little bit later this afternoon?
Well, I think as you guys were discussing, the data this morning is probably more important than what the Fed is going to tell us because this is a data-dependent Fed. So I think based on what we saw this morning, more likely we get a 2-cut baseline rather than a 1-cut. And Chair Powell, I think he's going to try to avoid sounding as enthusiastic as he did last December and encouraging the market to keep running, and instead say, look, we still have some wood to chop here. This is definitely encouraging. We still think the tilt towards rates is downward, but we're not in a rush, and we're going to gather a little bit more data.
Julie,
I think he has to take out that reference to lack of progress. We clearly are back on a path of progress, and I think they're going to acknowledge that.
how is economic growth? We've had this wonderful discussion. It's a parlor game, and I love the video that we had, September, December, see you in December, whatever the song was. Julia, Jim Bullard today of Purdue said he's got a 3.0% unemployment rate in West Lafayette. They can't get help at Harry's Chocolate Shop. SK Hynix of South Korea is putting $4 billion into Western Indiana. Is this a boom economy that Chairman Powell addresses this afternoon?
Well, I think the way to resolve the tensions you've just outlined is exactly what we've seen, which is a pickup in immigration. And that immigration is allowing the labor market to come into better balance. It's alleviating some of those shortages. And it's also alleviating some of that potential for inflation pressures coming from the labor market. So that's all kind of great from a macroeconomic standpoint. And Chair Powell has acknowledged that that has changed the way they think about growth potential. Growth potential of 1.8%. Well, that assumes very little population or labor force growth. That basically assumes about a 1.5% trend productivity growth rate and 0.3% population growth. We're running stronger than that. Labor force growth is running stronger. Immigration is fueling it. And, I think that boosts what we can see without causing an inflationary panic on the part of the central bank.
Julia, what do you think that's going to mean for the statement of economic projections? Do you think that the inflation forecasts stay the same? Does the unemployment forecast stay the same, to be basically the same as where it is right now at the end of this year?
I think they're going to have to bump up the unemployment rate forecast at 10. Again, basically saying that we've loosened, but we don't expect a lot more loosening from here. On the inflation side, it's a bit tricky, and they will have an opportunity to update after this morning's data. Probably a lot of them are going to take advantage of or took advantage of that opportunity. You're probably going to see a little bit higher, maybe 10 higher relative to the March projection. But, you know, today's data is a perfect example of how quickly things can change. Just as they changed in Q1, they're reverting back in Q2 with equal force. So those projections are only as good as the data ratify them.
Things have changed a lot over the last few days. It was only Friday we had that whole payrolls report, which we can talk about more in just a moment. Can I ask you about that? Actually, Bob Michael suggested that maybe this Federal Reserve puts more weight on the household survey. I just wondered, Julia, whether you'd echo those comments.
I was taught at the Fed to put equal weight on payroll and the unemployment rate. So both of them are telling us something about the labor market. And again, I think the way we square the circle is immigration, that you have more, a higher break-even run rate on payrolls required to keep the unemployment rate steady. So we don't take the jobs numbers at face value from the household survey. That's subject to population growth assumptions. But the unemployment rate is informative. And so it tends to be more robust to those population growth assumptions. So I think what we see is a labor market that has loosened from the tight labor market of a year and a half ago, but it's still healthy. It's still got strong legs, and you know what we've seen in the payroll survey that I like is the broadening out of hiring. It had narrowed down to 3 sectors in the second half of last year. We're getting a little bit of a broader base this year, and I think that's good news.
Let's bring Bob back into the conversation. Bob Michael, is that how you square the circle?
Yeah, I guess the question I have for Julia is which one of the surveys, the establishment or the household survey, captures the immigration surge that we all understand is occurring? Where is the immediate impact felt first?
So it's a great question, and the answer is really complicated, but I think in general, the payroll survey is thought to capture people that are earning money in the labor market in real time. Again, the household survey is a smaller survey, and the numbers of jobs really hinge on, they're applying the responses to an estimate of the population growth. So they're undercounting immigration. They're more likely to undercount immigration. Because they're basing it off stale estimates from the Census Bureau. And meanwhile, you know, the people earning money do show up on payrolls. Again, undocumented workers are undercounted in both, so it's a bit of a complicated story. But, you know, I think there have been some analysis out of Brookings and former Fed economists that, you know, kind of come to that conclusion that probably payrolls is picking up the immigration story better.
Bob Michael, when you talk to your short-term paper people, are we anywhere near close to where the joy of 5.x% money market funds drifts away? I mean, how much do we have to come down? How much does Jerome Powell have to jawbone us to where there's a rush of money into your world?
Well, I think once we see the first cut, then the market will start to project series. Then we'll all go back and say, hey, they never cut. On average, they cut 200 basis points, and that will get money pouring in. I think for the yield curve to make sense, we've got to bring the Fed funds rate down to about 3 3/4, 4%. Then to me, the 5 and 10 year makes sense where they are. That doesn't mean once the Fed starts the rate cutting path, that money won't come pouring into the bond market and drive yields much lower than that, maybe through 4%. What I'm hearing when I talk to clients is there is a ton of money on the sidelines. Some of the biggest investors haven't come into this market yet because of the inversion of the yield curve and what it does to their investment dynamic.
At this point, Bob, isn't duration better than credit, given how tight credit spreads are? We were talking to Woody Caesar earlier this morning. And if you really do believe that a rate cutting cycle is getting underway, why not just go long duration at this point and forget credit, given how it's basically rallied so dramatically?
I have completely the opposite view. As I was listening to Julia, what I heard was the balanced labor market is the stuff that soft landings are made of. And here we are gliding right into it. And you have nothing to fear in credit in a soft landing. Corporate profitability is great in the investment grade space. We already know defaults are close to zero. Nothing's going to be under pressure. So can I see spreads coming in from 80 to 90 basis points where they are? For sure. Can they go down to 60 basis points where they were in the 95 to 98 soft landing or 04 to 06? Absolutely.
Julia, I wanted to give you the final word. I wanted to borrow a question from Lisa from earlier this morning. Do you think there's someone on the FOMC who's shouting mission accomplished based on the last couple of months?
No. Central bankers don't shout mission accomplished.
They whisper
They go home to their spouse and sit down and have a quiet glass of wine and cheer with each other. They're not going to come out and say mission accomplished ever.
Julia Coronado of Macro Policy Perspectives. Julia, thank you. I'm just wondering how many quiet glasses of wine have been had. That's all. I'm just wondering.
It's just like a general feeling of quiet joy that they restrain with a little smile.
Remember where Chairman Powell was at the end of last year, right? And then we had this Q1, hot inflation story. A lot of people lining up to say that's a head fake based on the last couple of months. Do you think Q1 was a head fake based on what we've seen so far?
I think so, and there was a lot of discussion about that Q1 tends to run hot relative to the rest of the year. In terms of the Fed high-fiving one another, I caught this morning with Jim Bullard on. I don't see him doing laps around the Fed, high-fiving everyone.
I didn't hear it either.
Yeah, go ahead.
Can we have a surveillance correction? Julie doesn't have a glass of wine. She has a Lone Star long neck out of the tradition of the University of Texas. But no, I don't think they're anywhere near celebrating. But after the shock of these other banks beginning to cut, they're behind. That's, to me, the lead story here.
They still have work to do. And this, to me, is the big takeaway. They have work to do when it comes to credibility, and the hard work begins now. How do they finesse this at a time of political polarization, at a time where they're going to be accused of all sorts of things? They might have achieved something on the economy, but credibility is still a question that they need to answer at a time where a lot of people are calling it.
There's a word you'll hear in this news conference repeatedly, which is confidence, and we need more of it. How much more confidence do you think they need? How many CPI reports is that? No doubt you'll have a reporter in the news conference that might ask the question. How many more do you think it is?
Not many. They have to be relieved. If there's one emotion, that has to be it. Things continue to play out the way that they had hoped. I think they'd like to see just a couple more months of employment not getting hotter, maybe a little bit of capacity building in through immigration, and prices staying about where they are. And then I don't think they're going to wait for the 2% inflation target to be hit. I think then they'll talk about the long and variable lags and begin fine-tuning policy with a rate cut.
I started this show this afternoon by quoting Mike Gapin of Bank of America, but I left off the conclusion. I'll share the quotes again. This is what Gapin has to say. One giant leap for the Fed made Bramo laugh. More evidence that 1Q was an outlier, but still thinks the first cut comes in December. Even with all that really constructive language about what we've achieved this morning, at least what they believe we've achieved this morning, Bank of America still believes the first cut comes later this year in December.
It sort of goes to the question that we don't know what confidence means, right? We're going to be parsing through every iteration, every word. If they need confidence, Bob, you were saying it doesn't have to be that much. But Tom, at a certain point, do they have to have more confidence given the noisiness, the speed bumps that you've seen along the way?
They're going to be exposed. I don't see many speed bumps. I see nominal GDP 5%. You help me with Michael Ferroli. Maybe it's 4.8%, whatever. But there's an underlying animal spirit that belies whatever first quarter GDP was, 1.3, 1.4%. There's more of an enthusiasm now that gets them in control to where to what they want to get. Maybe they didn't have control last meeting. He's got more control of the dialogue this meeting.
That decision is about 30 seconds away. Let's go through the scores going into that decision. Equity markets right now on the S&P 500, record highs. On the NASDAQ 100, record highs. On the Russell, a rally of 2.6%. In the bond market, which is where the fun and games have really taken place over the last couple of weeks, Lisa, back and forth, one narrative to the next, back and forth, day after day, from data point to data point.
Jim Bullard saying it concerns him, the idea that we're not seeing any kind of stability in the bond market. At what point does it become disruptive? Right now, we're still seeing that massive rally on the heels of a really positive CPI print.
With your Fed decision, here's Mike McKee.
2 dots, no rate move. The median of the 19 Fed officials' projection for rate cuts this year moves to 2 from 3 in March. Policymakers are quite divided, however. 8 members see just 2 cuts this year. 7 see only 1. 4 vote no change. They now have 4 penciled in for 2025. Although the range is so wide, it's almost meaningless. The neutral rate also moves up. The median now 2.8% from 2.6%, although they don't get there until after 2026. 9 members see neutral as 3% or higher, 1 as high as 3.75%. The Fed's target range stays in the range of 5.25% to 5.5%. No change in the 2.1% GDP projection for 2024, 2% for next year. No change in the 4% unemployment forecast for this year, though 2026 moves up a tick from March to 4.2%. It's PCE inflation where we see the biggest change in the forecasts. Headline of 2.6 this year, up from 2.4% in the March projections. Next year, 2.3 from 2.2. Core PCE is forecasted 2.8% this year, up from 2.6%. Next year, also 2.3 from 2.2. Inflation was the only significant change in the statement following today's better-than-expected CPI. The statement now says, in recent months, there has been modest further progress toward the committee's 2% inflation target. The decision was unanimous.
Mike McKee, thank you, sir. If you were looking for fireworks in financial markets, you missed it all. It happened about 6 hours ago at 8:30 Eastern Time. And the equity markets, some of these moves stick. On the S&P 500, still positive by about 0.9%. On the NASDAQ, up by more than 1 full percentage point. 2-year yields, Lisa, just off the lows of the session, but still down 12 or 13 basis points to 470 on a 2-year.
There's nothing that would really shake up what we saw earlier. It is interesting, though, that they did increase their expectation for core PCE inflation to 2.8% versus 2.6%. And it raises the question about the idea of, are they tacitly allowing inflation to go be 2 point something, to Mohamed El-Arian's point, rather than exactly 2%, as they allow this to happen even with 2 potential rate cuts baked in.
TK, what's your takeaway?
My takeaway here is that 8:30 was really, really important, and it moves us right on to all the other economic data. And I go back to economic growth, and it's a surprise this year that we get more buoyant economic growth than a lot of the gloom crew's talking about.
I want to get back over to Mike McKee. Mike, just briefly, just work through that again for us. Explain to us where that median dot is. We were looking for 3 cuts in the median dot last time around. Where's that median dot for 24 now?
The median dot is at 2 cuts for 2024, 4 for 2025, but the range has narrowed considerably, but still broad, because there are, at this point, 8 members seeing 2 cuts this year, so that makes it the median. 7 saw only 1, and 4 voted for no change. So they seem quite divided, which would suggest that at this point, there is no consensus on the committee about what's going to happen the rest of this year.
Mike McKee, thank you, sir. Mike McKee will be in that news conference in about 27 minutes' time when it kicks off with Chairman Powell. Bramo, any early questions for Chairman Powell in this presser based on that?
Yeah, I do. Number one, how long will you tolerate inflation above 2%? How quickly is an okay pace to move to get inflation down? And the second thing, I'm still thinking about this. One participant had a new neutral rate proposal of 3.75%. That's pretty bold. I mean, it's pretty much in line with where markets are for 3.5%. Nonetheless, that resets a lot of questions about market valuations that maybe on the margins could really change investment theses.
Joining us now to discuss is Mohamed El-Arian of Queen's College, Cambridge. Bob Michael of JP Morgan still around the table with us. Mohamed, I want to come to you first. Get your view on these forecasts based on what we learned earlier this morning at 8:30 Eastern Time.
So I wonder, John, whether those forecasts fully reflect this morning or whether they were finalized before this morning. I was surprised to hear that 4 voted for no cuts. and I was surprised to see the inflation numbers go up, both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not?
Mohammed Tamkeen, good morning and good afternoon, I should say. Good late afternoon and evening to you. Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school, Mohammed, southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is a much longer time frame than we think? We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy, but that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months, but that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohammed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So, yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter, and this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
So if you are just joining us, welcome to the program. Equities still firmer by 0.9% on the S&P 500. We were higher by more than 1 full percentage point. Just undoing some of the moves in the bond market on a 2-year yield. Yields are lower still by 12 basis points. They were lower by a little bit more than that earlier on. There was a lot of interest in the median dot for 2024. Just want to clarify something that Mike was saying. They're now signaling they expect to cut rates only once this year, compared to the reduction of 3, which was kind of signaled back in March, Bramo. So that's the change we were looking for. Would we come down for 2 or to 1? It looks like we've come down to 1, but 2025 kind of makes up for some of that in some way.
Which is what some people were saying, is that you just basically push it out to the following year, which is why it might not have been a massive deal. There was a big question before this whether or not it would matter to markets on the margins. Maybe you take back some of the gains in certain bonds right now. Nonetheless, not a huge shift when you look at the overall cutting cycle.
But Michael, I've got the 10-year yield just touching 2 standard deviation move. It's not a big deal, 4.28%. And gyrating around. What level of 10-year yield do you need to really signal, to use Bullard's word, a new regime?
It's not so much the 10-year yield as the front end of the curve.
Okay.
I think the front end of the curve, you've got to see the Fed start cutting rates and then the front end start coming down towards 4%. I think that will pull the 10-year down as well a little bit, but there's an awful lot priced into the 10-year part of the yield curve.
This is an unfair question. I'm going to ask you to speak for Michael Feroli and Kasman and the other economists at J.P. Morgan. Do they do harm to the American economy by being ex post and delaying? What would your economists say?
They do no harm to anyone. That I'm pretty sure of. Look, I think when you look at market movements, you have to understand that there are different constituencies that are involved. We talk to a lot of very large plans that are waiting for the yield curve to disinvert because based on their investment analytics, it doesn't make sense for them to come out of cash into the longer end of the curve. There are other buyers out there that are looking to park cash into safe dollar assets. So they're big dollar buyers, they want to own the dollar, and treasuries are the largest, most liquid way to do that.
I have to say, I'm parsing through the statement and all the details, and it's a confusing one. So let's just go over it. 4 Fed officials see no rate cuts this year. That is up from 2 officials in the March projections. So that is a more hawkish tilt. 7 see 1 cut, while 8 see 2 cuts. Honestly, we're looking at right now a narrow majority seeing no more than 1 cut this year as a base case. This, according to the statement, I'm looking at this and I'm wondering, John, all the people who said this would be some kind of massive shift, it isn't being taken that way by the market as people parse through the longer term expectations for what the Fed hopes to accomplish and where the balance of risks is.
Because we had a soothing number at 8:30 Eastern time. I think that's kind of the takeaway. Yeah. Is that right, Bob?
Yeah, I think so. It's what I started with. This is what you look for in the numbers. If there are a lot of people clustered around 1 dot, then they don't change their projections after the number. They've submitted them, they let them go. The fact that there were 4 with no change, 7 with 1 dot, and only 8 with 2 dots, 2 rate cuts, tells me that they submit them, they don't do anything. The statement's completely different. The statement talks about modest progress continues to be made on inflation.
Let's get Mike McKee back into the conversation before Mike goes into that news conference. Mike, just to clarify some of the comments you had earlier, your thoughts?
Well, I misspoke, but 1 cut is the median dot this year, for this year. But it is, as you say, somewhat confusing because of the way they do it. But looking out over the course of the year, the question is, when do they do it? Because their PCE projection is basically for the year where PCE is now. So that's going to be a question for Jay Powell in his news conference.
Mike, you get into the presser. Thanks for your time, sir. Happens to all of us. Looking forward to your coverage in that news conference with Chairman Powell a little bit later. Diane Swank is with us from KPMG. I want to bring her into the conversation. Mohammed's still with us, Bob Michael as well. Dan, you've had about 15 minutes, 10 minutes or so to go over these numbers. What jumps out for you?
Well, certainly the upward rise in inflation I was surprised at. I expected them to mark down inflation a little bit, so that is one that I think Mohammed also flagged. But I think what's important is we know that they've delayed the marking down of their dots on the dot plot, and that has become more of an iterative process to reflect more of a consensus of what they do talk about at the meeting. So I'm not sure that there's the dissonance there that some would like to see in those numbers between today's data and those actual dots. I think what it probably did was took out of play some people who might have had hikes in their interest rate scenario for 2024 that then moved them to the 0 portion, those 4 people who voted for no change in rates. But I think that's very important, is that the Fed has also been very careful not to declare victory, as Julia said at the end of the last show, and I think that's really important. They don't go out and say mission accomplished. They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them. Now, I disagree that that's, sort of neutral and doesn't cause any harm. Data dependence, the data are lagged. And so by the time the data comes to you, even if you're willing to settle in to a higher rate ultimately, it's still lagged, and it could be after the fact. And I think that's what you see in terms of the nervousness with Jay Powell, because he worries much more than some of his colleagues about over-tightening.
Diane Swank, I look at where we are, and what the key thing is, as Bob Michael said, is we're beyond the first quarter of this year, the lethargy, the slowdown, maybe some of the fear of the first quarter. What is your take on the state of the American economy as they stagger to September and December?
Well, we're still in an economy that's generating a lot of jobs. The household survey and the establishment survey aren't quite synced up. They haven't been synced up for a long time, in part because we're undercounting the number of immigrants in the country, and that's not fully showing up in the household survey as well. But we do know that we continue to generate jobs, we continue to generate paychecks, and if the last month's report is to be believed, and we have to be careful on that we actually saw an acceleration in in wages. That's something to sort of, I think, take with a grain of salt. But at the end of the day, this is an economy that for the moment is still hanging in there, although slowing from what was a stunning pace in 2023.
Mohammed, I'd love to bring you back in here. I'm just going through all the different statements, and this is a mess. I mean, in terms of all the different views. This is not a consensus that you could see that was easily reached. Maybe there it is for right now, but later in this year, what the balance of risks here really is all over the map when it comes to the different Fed officials. Do you think that there is too much hawkish talk right now and too much hawkish projections at a time when it seems like the Fed is saying we still haven't done enough, we want to get to 2% a little bit sooner, even as we acknowledge this is going to be a battle?
Yeah, I think if you were to take the SEP and the statement fully on face value, this would be an overly hawkish policy stand for this economy. Among the other things, the fact that we are now at one cut means that given that the Fed will not want the stop, go cycle, that means that cut comes late in the year, very late in the year. And I agree with Diane, it does matter when you start the cutting cycle. It really does matter. It matters for small businesses, it matters for low-income households, and it matters for the economy. So if you were to take this at face value, then the market would be selling off right now. But it's not for good reason, and that's what I said earlier, and Bob mentioned it as well, is I don't think this fully reflects the latest set of data. And given that this is data-dependent Fed, if the data had happened yesterday or the day before, the S&P would look very different than it is today. And that's why the press conference is going to be so critical. And that's why Chair Powell cannot do what Bob wanted him to do half an hour ago, because he's really going to have to explain things now.
So, Mohammed, based on the guidance we've got in our hands at the moment, it sounds like December. Are you telling me by the time this news conference finishes, it'll sound like September?
I suspect so, John.
Bob, you agree with that, don't you?
Yeah, I completely agree with that. And I think Diane and Mohammed point out a very important thing, which are the long and variable lags are real. When we look at lower and middle income households, when we look at small businesses, they're struggling with the high cost of everything. They're struggling with the much higher cost of financing those higher prices. And you're seeing it in delinquencies, you're seeing it in charge-offs and write-downs and losses.
Right now, I'm looking at some of the commentary. Some people saying that the reason why there was a hawkish tilt was because of PTSD from the first quarter. Diane, I'd love your take on this. Do you think, and not to be all conspiracy theorists, but do you think that any Fed officials thought to themselves, you know, we should probably be hawkish just to offset the inevitably dovish message that we're going to get from Fed Chair Powell later today, and we can frankly offset that later in this year if the data comes in such?
Well, no, I don't think that's the case, just because I just don't think they think that far ahead on this, and I think that's important. I do think that part of what we're seeing here is, yes, they did go into this meeting with a hawkish tilt and the data surprise, but we know that, you know, Chair Powell has really changed the dynamics of the SEP, and I'm just surprised that given the timing of when they write this down, and, you know, the Fed had this data, you know, a lot of the Fed had this data last night, so they've been looking over it, you know, and came in strong with how they were going to talk about it in the morning. And I think they still have members of the board itself that would have gotten the data that would have said, you know, hey, we're still on the sidelines here, or one cut and that's it. So I think that's an important way to be thinking about where they're at, about what they think they need to be convinced on inflation coming down, not to get to 2%, to cut before they get there, but how much they need to be convinced. That's a lot, and I think they've set that bar pretty high, and it's because they have been head-faked in the past. That doesn't mean we couldn't see some big improvement and get to a September cut, but I think we need a lot of improvement from here for the Fed to feel convinced to do a September cut.
Suddenly this news conference in 12 minutes got a lot more interesting. Diane Swonk of KPMG. Diane, thank you, as always. If you are just tuning in, in and you missed the Fed decision. It took place about 18 minutes ago. Rates unchanged as expected. Big focus on the median dot. Basically, all the Fed officials get together. They plot where they think rates should be, will be for 24, 25 and beyond. You take the median dot, and a lot of people on Wall Street see that as a signal of how many times they're going to cut in any given year. That median dot was at 3 cuts for this year. It's come all the way down to 1. Worth noting, though, that they now see 4 cuts in 2025, more than the 3 that they previously outlined. So they've pushed some of that into next year. But the range of views, I think the median marks a very, very divided Fed. And Lisa did a fantastic job of that a little bit earlier, really explaining it, Lisa, that 4 policymakers see no cuts this year. 7 anticipate just 1 reduction. 8 are looking for 2. That's the Federal Reserve that's all over the place.
And that really does have at least half of it a really hawkish tilt right now at a time when other people are saying, you know, we'll do it for the Fed, mission accomplished. So it raises this question, at this point, what is keeping them from really going all in on the immaculate disinflation? Is it just PTSD from Q1? And will all of the sort of questions that people have around the hawkishness just disappear in the wake of the bomb that Jay Powell tends to bring us?
Mike Gapen of Bank of America is with us now for more. Mike Gapen, I was sharing your words a little bit earlier, that quote from you, one giant leap for the Fed. Then I explained that you still don't think they cut until December, so it's not that big a leap. What do you make of what you've heard in the last 20 minutes or so?
Well, if we thought it was September or a sooner cut, maybe it'd be one giant leap for mankind instead of the Fed. Like I think what Bob and Mohammed have been saying here, I think I would share, which is I think the data is probably more important than the dots in this case, because it is such a data-dependent Fed. They don't want to take these structural longer-term views, so they'll be reactionary. So it may be that the dots kind of lag what's happening on the ground. Look, I would just characterize all this as an incremental shift in Fed thinking, that they were trying to target us to the middle of the year. Inflation didn't cooperate, so they shifted things back. I would encourage them, like Mohammed is saying, to take some stands on longer term structural views, but this is not the Fed that we have.
Michael, how exposed are they? I go back to the Bank of America work of their very retired Ethan Harris's wonderful book, Ben Bernanke's Fed. Okay, great. Are we still back at Ben Bernanke or Alan Greenspan's Fed, where they are exceptionally exposed?
I don't think so. I just think it's they believe, I think as you're noting in the dots, there's a wide disparity of views, and sometimes pulling the view out of the median is a fool's errand. So it may just be that there's not a lot of structural or agreement about these longer term structural issues, so it's hard for them to be forecast based. And so you just get a plethora of views, and so they throw their arms up and say, fine, there's a lot of uncertainty. The only thing we can trust is the data under our feet, so that's what we'll focus on, for better or worse.
Michael, what would be your question to Fed Chair Powell this afternoon?
How much was the data this morning reflected in the projections and the dots? If the answer is yes, it sounds a little hawkish. If the answer is no, then you can make a case for September still being on the board. I think the data could make a September cut viable. We just think it all comes together in December. So the dots and the forecasts are kind of a Mike forecast right now. So I'm pretty pleased with those.
Mohammed and Bob have got the same thoughts. Let me tell you. Mike Gapen of Bank of America. Mike, thank you, sir. Mohammed, I wanted to come across to you on the forecast, but not on the dots. I wanted to talk about unemployment. When they reflect on what we learned on Friday, and you were with us, working through that payrolls report, just the difference between the two surveys, how do you think this FOMC is navigating that at the moment?
I think it's navigating like everybody else, trying to maintain optionality, trying to understand what's going on. And it's not just the employment data. We've had a lot of competing macro data. So, they're just waiting. I do think there's two things going on. Certainly the uncertainty is making them data dependent, but there's something else that's making them data dependent, is what happened in 2021. When they did take a view on inflation, they took a strategic view on inflation, and it turned out to be really wrong. And I think they've been burnt, and they don't want to go back to that fire anytime soon. So they will not be trying to reconcile the data. They will not be trying to anchor markets and their own thinking with a forward-looking view. They're going to continuously react to the latest set of data. And that's what I think you're going to see.
which could be good and it could be bad, according to you, Mohammed. Bob, I'd love to bring you back in. At a time when it seems like this is a Fed wrestling with itself, the consensus on the top is a mirage. Sure, there's consensus not to cut rates at this meeting, but that's pretty much it. What does that signal for you in terms of the clarity of purpose of their policy going forward and how to really navigate around it?
Great question. If I were Mike McKee, I'd ask the Fed, have the summary of economic projections outlived their usefulness? Do they do more harm than good? And if the answer is no, then I'm sitting here, we're told to look at the summary of economic projections, and it's reflecting a Fed that's confused. And you know what? Even if they submitted the projections before the CPI data, one bit of data shouldn't create that much of a change. So this is a confused Fed. What that tells me is the bond market is in the hands of people like me. I don't know what the Fed's thinking. I don't know what they're looking at. I don't know what they're going to do. All I know is current levels. I know our projections of where growth and inflation are headed to. I know the amount of buying that's going on now. I know who's waiting on the sidelines. I look at this. It tells me I certainly don't want to be short duration or underweight relative to benchmarks. I want to be somewhere around neutral. I want to be concentrated in the front end of the curve, and I like credit because everything's telling me we're gliding into a soft landing, and that's good for corporate America. It's also good for corporate Europe.
Dr. El-Arian, help me translate this, and you can do this out of the Pepys Library, Cambridge. What in God's name is modest further progress?
It is changing a phrase that used to be somewhat more hawkish to something that is less hawkish but not dovish. That is what that is.
Mohammed, you've said for a while that maybe they're making a mistake, that they haven't taken this strategic view, and you were hoping they'd go sooner rather than later. Can you help us understand the difference between not going three but going once, and the difference between doing that one cut at the end of the year as opposed to doing it in July? What difference does 4 or 5 months make?
So I love listening to Bob Michaels, or is it Bob Michel, John, as you told me last time? Anyway, I love listening to Bob Michaels' soft landing scenario because it's very soothing. But analytically, based on how I assess the economy, I give it a 50% probability. It is the dominant scenario, but it is not dominant with high probability. So I have to have a risk mitigation mindset. And then when I look at the tails, I see the tails of recession being larger than the tail of bigger but not hotter economy.
But Michael, your take.
When I look at that distribution and I look at the asymmetrical tails, I start asking, what are the buffers in the economy? And that's where I start getting worried. And that's where the delay of the rate cut means that those buffers that are already quite limited among small businesses, among low-income households, get eroded really quickly.
Mohammed, you've been around as long as I have. You're right. We've only seen one soft landing in our investment career, and this is 40 plus years, and that was in '95. So soft landings are incredibly hard to engineer. In fact, just the probabilities are way against you. But what worked in '95 is, I think, what you're alluding to. The Fed came in and started cutting rates. They cut rates 75 basis points in '95. It was just enough to take the pressure off of businesses and households, and thus we had, I believe, the only soft landing in our careers.
Mohammed, we've got enough time to give you the final word.
I love what Bob just said. Thank you, Bob.
Mohammed El-Arian of Queen's College, Cambridge. Mohammed, thank you. Not sharing that. Neil Dutta of Renmac just writes in, the Fed thinks unemployment is going to be flat for the rest of the year. Good luck. That's the take from Neil today.
Yeah, he thinks that this is the beginning of a pretty rapid weakening and the Fed needs to cut next month. What Bob said, I think we have to sit on it for a second. He said that he, as bond guy, is taking control of the market. The Fed is no longer in control because it is a confused Federal Reserve, and the bond kings are over there just cleaning up and figuring out what the supply, the demand is, and the technicals. This is a new world, which is the reason why yields have been swinging around like penny stocks, because essentially the Fed is not the guide anymore. It's a battle of wits and a battle of vision that you have between different bond kings.
Okay, if this world bond market, if this treasury market behaving like a penny stock, is someone in charge? Can you explain that to me a little bit more? How are investors in charge of this bond market? 1 minute it's hot, yields are flying. The next minute it's cold and yields are diving.
That's right. There isn't any central planning right now, and that's what you get. And you don't have the absorption tool of a lot of the big banks because their balance sheets are smaller. So what you get is that whipsaw kind of action of no one in control, of a lot of people taking charge, but no one in control.
They'll say we're data dependent. This is what it's all about. The market's just reflecting the incoming data.
Correct.
From data point to data point.
Correct.
This is by design a feature and not a bug.
So when is that a problem, right? We even heard James Bullard saying this is potentially a problem if you have this degree of volatility in the benchmark rate for the entire world, as we saw earlier this morning.
2-year all over the place. We're down 12 basis points today, 471. In just a moment, that door's going to open and Fed Chair Jay Powell's going to walk in. There's going to be a lot of questions, but the number one question we all have in the last 30 minutes is, did you factor in the inflation report that came out at 8:30 Eastern Time into the forecast you just unveiled 30 minutes ago? I don't think there is another question to ask in this press conference once it starts.
And Michael Gapin put it really well. If the answer is no, we did not, well, it's not that hawkish. If the answer is yes, we did, that is a hawkish tilt at a time where a lot of people view that as progress and even reason to celebrate success.
The most important thing I heard was from Bob Michel, and it was him talking about parts of America.
A new name for Bob now.
It's a new name. Talking about parts of America that are not enjoying this financialization. They're not enjoying it as haves. And to me, John, that's a key issue.
Here's the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. And to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. it's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summer of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level